Good morning, everybody. I'm a few minutes early this morning. Just thought I'd say, hey, I love it when the room gets chatty in the mornings. Hope you guys are doing great. Hope everybody is ready for the day, feeling good about the world, making sure that my sound is connected. Debbie, beautiful Trey. David, how's it going? Dwight, nice to see you. Bobby, I'm jealous of your 60s. Ron, that trade was just for you, my friend. Every now and then I see them, and I feel obligated to catch them. Um, Sometimes you guys are the teachers, sometimes I'm the student. It's kind of cool how that works out. Um, we saw news this morning. Robes are on order. We saw news this morning at 8:30 a.m. and it was pretty much a dud. It didn't do much of anything for the market, guys. It really just didn't do anything. At 10:30 a.m. for my crude oil traders, we do have crude oil inventories. Um, which means that crude oil can be a little silly up until, good morning, John Novak. For those of you that maybe have taken the day off or the week off, I'm going to show you on the market analyzer. Crude oil has rolled. We are in the December contract now. And I'm going to build the market analyzer. We're going to see where the volume is on that crude oil. I've already rolled my chart. So that is November crude oil trading at 20,000. Meh, not so much. And then December crude oil is trading at 130, guys. So if you haven't taken the time to roll over your crude oil charts, you are in jeopardy. Good morning, Luciano, of saying something clever like, hey, Mark, my fibs don't match yours, or hey, Mark, my crude is trading at a different price, which is okay. It means that you're on the November contract, not the December contract. But guys, that's where the big boys are playing, is over there on the big one, or on the newest one, on the December one. I check news every morning. I want to make sure that I'm not missing anything, any releases that might. Um, Great, that's gonna be stuck in my head for the rest of the day, Ron. Making sure that I know where stuff is happening. Good morning, Snorri. So Wednesday, October 18th, guys, there's a lot going on in the afternoon, right? Nothing that should affect us too much. 3:15 Eastern. Harker speaks again. Harker seems to speak a lot, never says much. But we do have crude oil inventories at 10:30. And once those crude oil inventories are released, things may jump and bump, guys. So if you're a crude oil trader, make sure that you write that down on a piece of paper. Set a reminder with Siri, right? And tell her to remind you. Um, and then everything that I'm talking about, guys, each and every morning as we roll into this 9 o'clock hour, comes from the education page, specifically the tutorial page. This is where anything and everything that you could possibly need comes from, guys. And I say that with a lot of confidence. I don't withhold information, I don't hold back. I try not to ever give you things that you don't need. If I ever do, it's unintentional. And I'm a huge fan of simplicity, guys, because I think during the learning process, simplicity is key. There's a reason that you learn basic math before you learn subtraction, before you learn division, before you learn multiplication, and then before you get to algebra, right? There's a definite process. You're building a foundation. We're going to do the exact same thing in this classroom, and our foundation as a brand new user with Nexgen, or our foundation as somebody trying to get back to consistency. Maybe you turned into a chart reader and you started seeing everything and tried to catch everything. That's a pretty normal part of the path. We're going to focus on a high probability trend trade. We're going to focus on a trade where each indicator on every chart agrees for the trade. You're going to typically have your strongest triggers, nothing in the way, no trouble spots between your entry and your target. And guys, this will be our focus for the first hour of classroom. And this is our focus every first hour of the classroom. I'm going to talk about the rules. I'm going to talk about the advantages that they provide. We're going to talk about where to find them, what they look like, and how to piece them together. Not only to take the trade, but also to be able to go back and historically study the trade, to be able to back test the trade. This high probability trend trade is designed to turn you into a chart reader. It's a trade that when you follow the rules typically wins 70 to 80% of the time. So there's an enormous amount of confidence that comes with understanding this trade because your success rate is higher, and confidence comes from that memory of success. But chart reading is about 90% of what you're going to do during the day. You're going to open up charts and you're going to look at them and you're going to be forced to say to yourself, my rules aren't met, I'm not taking a trade. And you're going to train your brain to wait for advantages, to wait for all these things that the high probability trade gives you. And then when they're present, that's where that 10% comes in. That's that 10% that has you entering a trade and managing a trade. But your chart reading is going to make it easy for you to recognize these advantages. And chart reading incorporates three pretty essential elements. Um, You'll be able to look at your indicators and understand where the market is likely to continue. This continuation point becomes the entry for your highest probability trend trade. You'll understand where it's likely to go. This is going to allow you to adjust your targets to get the most out of trades when your indicators tell you it's appropriate. And you're also going to be able to identify where the market is likely to stop. This likely to stop area that we call termination conditions has two separate roles. The first role is to keep you trading into areas, Fibonacci-based indicators that may halt the trend. But the second thing is that it acts as an anchor. And there's a whole section dedicated to your first 30 days. Finding entries for the highest probability trend trades and finding the ones that set up after one of these likely to stop spots. When a termination condition ends the trend, reverses the market, and gives you your rules met, that's your highest probability trend trade that you can take. That's the one that typically wins 70 to 80% of the time. That's the one that your chart reading is going to have you identifying. And this is going to be your focus for about 20 days. Whether you're on a demo, whether you're in your first month, we're going to get you to where you can identify these spots, understand these spots, and enter the trade for this highest probability trend trade. See some new faces in here today. AC Trader, nice to have you. Who else is new in here? I know we've got a couple new ones. Guys, if you are brand new, I want to remind you that this is your class. This class is a little bit of a lecture in the beginning, but it's very much a discussion. I want to hear your 2 cents. I want you to throw all your questions in there. And I want you to make sure that you get clarity on the concepts. Good morning, PFI. Nice to see you in here. So we're going to focus on one trade initially, guys. We're going to focus on the highest probability trend trade. This is a trade that only has three rules. That's it. Three rules. Each rule provides an advantage. Rule number one will provide you the advantage of momentum, making sure that you're trading a market that is likely to continue in the direction of the trend. Rule number two, make sure that none of those key likely to stop areas are in front of you, that you have room to your target. And number three is designed to get you into the market at the most advantageous spot, that best of the best area where it's likely to continue. These three rules for the high probability trend trade, guys, they are easy to remember. I've kept all the words out of them so that they're nice and concise. And they happen on only two charts. That's the beauty of it, is less is more. Simplicity is key. Everything that we do starts on a large chart. The large chart leads the way. Your large chart is a reflection of the large crowd mentality, the people that move the market, the movers, the shakers, the institutions, whatever you want to call them. These guys are going to create momentum. These guys are going to establish direction. These guys are going to define the areas. So your rules are designed to take that broad stroke of a brush. One bar, the most current bar on your large chart, will define these three things. And your first two rules happen on that large chart. And when they're true, you will have the advantage of momentum and you will have a clear path, nothing between you and your target. Once these rules are true, and only when these rules are true, you'll turn your attention to the smaller chart, your entry chart. And your entry chart is a reflection of what the small crowd wants. The small crowd is going to buck the system. They're going to fight the large crowd. They're going to go against momentum. They're going to go against the trend. And thank goodness that they do, because these guys are going to get you guys to your perfect entry. These guys are going to get you to the absolute best of the best entry. So your small chart becomes a refinement tool. What happens in only one bar on the large chart is very much 15 to 30 bars on a smaller, faster chart. It's going to allow you to reduce your risk. It's going to allow you to maximize your profit potential. And that's rule number 3, designed to get you into the market. So we're going to talk about this high probability trend trade. We're going to focus on it very much to give you guys advantages, to give you something to focus on these entries, to get you in. And then from this high probability trend trade, I'm going to go ahead and introduce it right now. I'm going to go back to the glossary of common terms. Your ability to read your indicators, your ability as a chart reader is going to open the door for what we call a medium probability trade. And a medium probability trade is defined in when most of your indicators line up for a trade. However, a small issue exists. We've all been humans long enough to know that small issues always pop up, right? Your ability to read a chart is going to allow you to identify these small issues. And it will be the vast majority of your trades. And we will introduce a plan today to get you into these medium probability trades in the most consistent fashion. But when you're executing medium probability trades, when you don't have all 3 advantages in favor, you have to manage them assertively. And your ability to read charts is going to allow you to do that. You'll be able to identify your trouble spots. You'll be able to get quick profits, to get to a 0 loss level. And it's the next level of your trading. So we're going to focus on the high probability trend trade first. That's going to be the best of the best initially. And I'm going to remind you guys before we get into the rules, your path to becoming a confident trader ASAP. This has been proven time and time again. Many of you are going to fight it because we're all so darn smart. I know I fought it tooth and nail for a while. But it starts with posting your trades in class, making sure that you can take a picture of your screen, that you can drop it in the room, that you can tell me what it is that you're doing. And more importantly, tell me why you're doing it. Tell me what you see. Write your rules on the chart, guys. You can write the rules for your own personal trading plan. I'm happy to give you feedback. Or you can steal the rules that I'm going to give you. Write those on the chart, and we'll go through your chart reading and make sure you have an understanding. Drawing arrows to your rules being met helps me get an idea of what your awareness is of the rules. Showing me the large chart, showing me the small chart, showing me your timestamps and prices so that I can line up the advantages on the large chart with your entry on the small chart, and then showing me where you entered, why you entered. This little bit of information is how you and I are going to have a conversation. So for my newer folks, every time you post a picture in the room, it's the equivalent of getting a private session. I'm going to look at your charts. I'm going to talk to you about the advantages present. I'm going to talk to you about the advantages that maybe weren't there. We're going to discuss entries, we're going to discuss exits, and we're just really going to work together hand in hand to get you where it is that you said you wanted to be, to get you comfortable, to get you consistent. So the more pictures that you post, the more private sessions you get in a day. I'm here for 3 hours every day to do that for you. And then the second half is tracking your real-time performance in the spreadsheet. You're going to be on simulator, you're going to be taking trades, and hopefully you're going to be making a lot of mistakes so that you can learn to correct those mistakes. But the spreadsheet that Nexgen provided you, it's in the Nexgen Study Picks folder, is just a trade journal. It allows you to put your trades in, and it's going to ask you what type of trade, what did it look like, what were your conditions, how did it end up, and there's a little notes section. So when you do things well, put it in all caps. Don't miss this trade. Or if you make a mistake, that's okay. Put it in there. But what you're going to do is every morning you're going to study what you did yesterday. You're going to say, okay, what worked? I'm going to try and repeat that. What didn't work? I'm going to try to avoid that. And you'll find that there will be things that feel easy, that keep you relaxed, typically when advantages are present. You'll also find that sometimes it feels forced, that you get a little nervous, that adrenaline starts kicking in, and you're really going to see a correspondence between that feeling and breaking rules. So this little study each morning, 5 minutes, drink your coffee, look at yesterday's trades. I'm telling you, it's going to set you up for the day, and it will accelerate the learning process. We're going to spend the first hour. We're going to talk about the trigger lines. We're going to talk about the Fibonacci rules for when it's okay to trade. Your job will be to simulate over and over, to keep practicing the rules until you're taking the correct rules. You're probably not going to know if you are in the beginning, and that's where these pictures in the room become so important. Get that feedback, guys. I'm here to help. We don't want you practicing the wrong rules because while you may get lucky on that simulator, it's typically setting you up for long-term failure. We're going to simplify a lot in this room. We're going to focus on that high probability trend trade, and then we're going to talk about one of those medium probability trades. And I'm going to give you a plan for it with a set of rules, a checklist to follow, even a management plan for it. You need to decide what looks you'll commit to and then commit to them, right? The most consistent traders that I know take the same darn trade each and every time. And you have to learn the Fibonacci and trigger looks so they're easy. So your spreadsheet that's provided to you gives you the trade journal on the first page. Your second look is your perfect trade, the trade that you're going to trade, whether it's a high probability, a medium probability, a momentum, an edge, whatever it is, you should have 100 pictures of that trade being successful, and you should be able to establish that it does win more than it loses. And then on the third page, guys, I've got these client trades. These are you guys in the room posting your trades, getting feedback, embracing momentum, embracing entry areas, embracing clear paths, and doing it your way. I always drop my spreadsheet in the room for my brand new users. So AC Trader, it just got dropped in there for you. Steal it. Go through and look at these and burn these images into your mind. And what you're going to be able to do is click on some of these, and it's going to show you exactly what I teach every day. It's going to show you exactly what to look for, and how to look for it. And it's just going to reinforce those looks because once those looks become easy, it's just rinse and repeat each and every day. So let's get to the high probability trend trade. The highest probability, the best of the best, the one that typically wins 70 to 80% of the time when you're following the rules. And everything starts on the large chart. The large chart must have strong triggers. And in order to have strong triggers, you have to be trading with the trend. So let's define trend. If the background on your large chart is green, you're in an uptrend, and you should only be looking for rules to be met for high probability trend trades long. If the background is red, you're in a downtrend, only looking for rules to be met for high probability trend trade short. Guys, this is a huge advantage coming right out of the gates. Never fighting that large crowd, never fighting the people that move the market. And this is also the easiest lesson that you're going to get today. I feel comfortable saying that every one of you is already an expert. And if I look at the market, this is the S&P, and the background is red, the most current bar. We're in a downtrend. It doesn't mean that I have a short trade, but it does mean that I'm only looking to take that market in a short position. Crude oil is on its way up. We're in an uptrend, only looking for rules to be met for high probability trend trades long. And then the NASDAQ is also going up, only looking for rules to be met for high probability trend trades long. It doesn't mean that the rules are met, but it means that my focus is making sure that I never fight the people that are in control. Rule number one says that I must have strong trigger lines. And in order to have strong trigger lines, I have to be trading with the trend. So it's impossible to follow rule number one and fight the trend. Because in an uptrend, when my background is green, strong trigger lines are defined when these small trigger lines, the solid lines, break above the large trigger lines, the dashed lines. These two work together to define momentum. And it's the separation between the two from the point where they separate until they return that lets me know that the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum is one of those key phrases that you're going to hear in class all the time. And when you have those strong trigger lines, it is the most favorable look for using that smaller, faster chart to buy a pullback to Fibonacci support or sell a pullback to Fibonacci resistance. In the downtrend, the rules are the same. Separation between the small and large. Both are wide, both are angled in the direction of the trend. This is a market likely to continue down. This is a market likely to continue up. And guys, it becomes easy to recognize. You'll see it on the first bar. And if we go back to the live market again, smalls are above the large. Both are wide, both are angled in the direction of the trend. This is odds favorable momentum. That's the first rule being met. Larger flat, smaller overlapping. This is not odds favorable momentum. This is not a market likely to continue in the direction of the trend. And then on crude oil, once again, there's that odds favorable momentum. Smalls above the large are wide, they're angled in the direction of the trend. The separation between the two lets me know that this is, in fact, a market likely to continue up. If you have strong triggers, you have to have the opposite, right? The weak triggers. When your small triggers work their way inside of the large triggers, um, think of scissors closing. You can't cut. When scissors are open, it's time to get some work done. These weak triggers let me know that anything can happen up or down. It becomes a little bit of a crapshoot. One is odds favorable, one is anything can happen. One is strong, one is weak. Words have power. When you have these weak trigger lines, very often you're going to see a market that reverses. You're going to see it coming into key areas. And it's just your little heads up that you've lost that advantage of momentum, that rule number one is not in place. And rule number one is going to happen throughout the day. Guys, this is a 5 hour stretch in, I'm not sure what market, maybe crude oil. But if you start on the left, you notice that odds favorable takes you to anything can happen. And it's at that anything can happen trigger look that the market reverses. From the reversal, odds favorable momentum, there's one of those tails, one of those wicks on the large chart. This tail is nothing more than a retracement on the small chart, guys. This is where you're going to be able to pinpoint exactly where that market is likely to continue. This becomes the Nexgen user's entry for the high probability trend trade. The market continues up right to those weak triggers. There's another reversal that provide odds favorable momentum and another one of those pullbacks at potential entry. And then we get into why rule number one is so effective. Um, you get into a fight between buyers and sellers. When the people that control the market don't agree with one another, when the people that control the market are opposing forces, you'll see that reflected in the trigger lines. Sometimes the small are up, but the large are down. And sometimes both large and small may be down, but your trend is up. And that agreement isn't there. Rule number one isn't met, and this gives you the opportunity to sit on your hands and do nothing, to let them fight it out, let them go through the losses, let them get overrun, because eventually this struggle ends and somebody's going to win and provide you odds favorable momentum. This is where next gen users have the advantage of not trying to predict what the market will do, but rather wait for that clear advantage to get into the market. So that's rule number one, guys. This happens on the large chart. Notice that thing's still going up, right? With all that momentum. Same thing with the NASDAQ. It's still on its way up with the momentum, even into key areas. So rule number one sets the tone. Rule number one is going to hide mistakes. Rule number one is going to give you the opportunity to make sure that you're trading with a market that's likely to continue in the direction of the trend. Rule number two is probably the wordiest of all of them. Rule number two is going to have you defining termination conditions, areas where the market is likely to stop. Termination conditions can end a trend. Termination conditions can create a bounce that's untradeable. And termination conditions can create indecision. They can create that fight between buyers and sellers. So once you're comfortable with a simple recipe to recognize them, you give yourself the advantage of never trading into areas that might mess up your good time, guys. And it happens on the large chart. Termination conditions must be false. And the areas that we're looking for on that large chart, the areas where decisions are being made by the people that move the market, are going to be divergence high lines, the magenta line that prints from a pivot where there was a loss of momentum. It can be divergence low lines, the cyan line that prints from a pivot where there was a loss of momentum. It can also be yellow one-to-ones, Fibonacci resistance, the red fib, or Fibonacci support, the blue fib. Each and every one of these lines has the potential to stop the market. We're going to incorporate a very simple two-part process to understand if it's likely to stop the market, or if it has the potential to break, or if we've cleared that problem area, guys. And it all begins with price reaching the area. And when I say price reaches an area, I mean that these dynamic Renko bars that are just a reflection of price come down to, and in this case, reach Fibonacci support. Once price reaches an area, the only thing that you need to do is ask yourself, where are the trigger lines? If the trigger lines remain above support, you've reached a termination condition. Price reached, triggers remained above. This is where Nexgen users are going to sit on their hands. They're going to say to themselves, I don't know if it's going to break. I don't know if it's going to hold. I don't know if they're going to dance there for the next 6 hours. Because I'm not sure, I'm going to do absolutely nothing. I'm going to wait for that advantage of a clear path. That advantage of the clear path presents itself if you look at where price reaches support up here and the triggers remain above, moments of indecision. If your small triggers get through the area with odds favorable momentum, it has the potential to break, but it's not broken yet. But when both small and large get to the other side of support, look how it begins to act as resistance. It turns red. Look how with that odds favorable momentum, the market pulls right back to that key area. Support is now resistance. The path is clear. Next-gen users are entering the market right here and taking it down to that next key area. Your easiest trades come with a clear path. And it really is a simple recipe, guys. Price reaches, let me find the picture. Price reaches the area. Ask yourself where the triggers are. If none of the triggers have broken through, there is no trade. If both small and large get to the other side of the area, now the path is clear. Rule number 2 is true, and that'll set you for looking for those entries. Is everybody comfortable with the idea? I'm going to also show this one. This one shows the potential to break as well. That potential to break is going to be your first medium probability trade. But the recipe never changes. Price reaches. If the triggers remain below resistance, don't trade into resistance. Wait and see. If the smalls break through with odds favorable momentum, this area has the potential to break, but it's not broken yet. Rule number 2 still not met. And then if both the small and the large get through the area, now the area is broken. Resistance begins to act as support. There's odds favorable momentum, and there's one of those tails, one of those potential entries for you new users to catch the best of the best trade. You're going to see termination conditions all day long. And we're going to go through a couple of them and the terminology that goes with them. This is what we call a pivot stop out of a prior divergence line condition. When price pushes down and heads back up, it forms a pivot. All a pivot is an up and down or a down and up. If the buyers steal the momentum from the sellers, you're going to know it through the cyan line. It's actually the price that creates this line. It's not price that reaches the line. Them stealing momentum creates the line, and then if the sellers push back into that divergence line, price reaches an area. Ask yourself, where are the trigger lines? If they remain above the area, above that line, no more short trades into this line, guys. It's a termination. It may reverse the market. And if it does, we're going to call this a strong bottom. A termination condition that reverses the market is a strong bottom. And you're going to see these pivot stop outs on a larger chart. They can be very powerful. They become even more powerful when they coincide with Fibonacci resistance. And this is the picture that I show every day that reminds you that 90% of your day is spent waiting for advantages. 10% of your day is going to be hopping on those advantages and getting in a trade. The market pushes up, and it pushes up directly into Fibonacci resistance. Once it reaches Fibonacci resistance, all you have to do is ask yourself where are the trigger lines. If none of them break the area, sit on your hands and do nothing. It may create an untradeable bounce, right? It may create a reversal in the market. In this case, it pushes all the way back to Fibonacci support. And then when price gets there, none of the triggers break. So we can't go long, we can't go short. 90% of our day is spent waiting for advantages. From support, the market comes back up to resistance. No triggers break through resistance. That's a termination. It also reaches that divergence high line. No triggers are able to break it. There's two in the same spot. And it creeps past to that next level of resistance. All the triggers remain below. That's 3 terminations in the same spot. We have a pivot stop out of a divergence high and 2 areas of resistance that say this market isn't likely to go any higher. Guys, when this reversal or this termination creates a reversal, gives you separation between the small and the large, this becomes your highest probability trend trade ever. That high probability trend trade that happens after a termination condition, this is the one that typically wins 70 to 80% of the time. It's what you do when the advantages aren't present that's going to determine how much of those winnings you get to keep when that one does win 70 to 80% of the time. And then we'll do one more termination condition to remind you guys that rule number 2 is designed to keep you safe. Rule number 2 is designed to keep you out of trouble because even with odds favorable momentum, the market reaches these yellow 1-to-1s. And when it does, none of your trigger lines break. It's a termination condition. No trades into those 1-to-1s. Newer users, do me a favor. Give me a Y if you're with me here. Price reaches an area. Simply look at your trigger lines. Determine whether or not you have a clear path. Awesome. Sellers push to 1-to-1s. The buyers fight. The sellers fight back. The buyers fight. The sellers fight back. The buyers fight. The sellers fight back. There's no reason for Nexgen users to ever get caught in these fights, guys. You don't have odds favorable. You don't have a clear path either direction. You're waiting to see who's going to win. Eventually, small and large get above resistance and it turns into support. Smalls are outside of the large. You have momentum. And there's one of those pullbacks, guys. This is your highest probability trend trade that you can take. This is the trade that typically wins 70 to 80% of the time, the trade that creates confidence through the memory of success, and look how it carries all the way up to that next key Fibonacci area. It's what you do with 90% of your time that's going to determine your success when that 10% presents itself. So guys, this is using areas for terminations. It really is pretty simple. Price reaches where the triggers. Sometimes price doesn't reach an area. Sometimes price doesn't get to the area and it has odds favorable momentum and a clear path and everything says up. I'm going to give you one more termination condition that's going to allow you to identify change using a smaller chart when the large chart isn't showing you that a reversal is imminent. And it's 3 divergences. 3 losses of momentum in the same location may terminate the trend. It becomes more powerful when your small triggers work their way inside of the large triggers. That's those anything can happen triggers. And it becomes more powerful still when your third divergence is higher than the previous from a low, or your third divergence is lower than the previous from a high. This look at a low, this look at a high is going to help you identify the change on a faster chart, on that broad stroke of a brush that you won't see in the moment. These 3 divergences tell you no more short trades, no more long trades, but they're also going to become a very valuable tool as you learn to manage your trades. If you're in a short position and 3 divergences print on that entry chart, you know that it's time to take profits. You know that it's time to sit on your hands to wait to see what the market wants to do. And if you're in the perfect long and those 3 divergences print, it'll give you the opportunity typically to protect your assets a little bit. So guys, these are termination conditions. With the exception of the 3 divergences, you're going to find them on the large chart. But these are the ones that are going to identify your clear path, guys. These are the ones that are going to give you that advantage, letting you know that there's room to your target, so there's nothing between you and the place where you want to get paid. And when you couple that with momentum, 2/3 of the equation is taken care of on that large chart. Once you have them, it's time to find that entry area. And this is really the magic of the methodology. You're going to be able to pinpoint with pretty amazing accuracy where the market is likely to continue. You're so much so that you're going to wait for the market to come to you with a limit order. And we're going to have that limit order waiting at areas. And when I say areas, I mean Fibonacci support or resistance, yellow 1-to-1s, or even a mid-band on a smaller, faster chart. But we're going to make sure that those areas are buried inside of favorable large triggers. So I'm going to define favorable large triggers first. Favorable large triggers mean that on your small chart, on your entry chart, that your large triggers, the smoother dashed lines, and your synthetic triggers, those kind of stepped lines, they should be trending one on top of the other. They should both be wide. They should be angled in the direction of the trend. And it's them overlapping one on top like snakes riding piggyback that's going to give you the smallest window of opportunity. And that smallest window of opportunity is going to give you the least amount of risk on a trade. So favorable large triggers means that you're looking at the smaller, faster chart and you're waiting for a scenario where they agree where they're one on top of the other, and where they give you that smallest window of opportunity. And you're going to see that each day, every day. And what's cool is with odds favorable momentum and that potential to break, there's one of those potential entries, and it lines right up with resistance inside of favorable large triggers. That's really what we're going to do right now. We're going to identify how to recognize where that bounce is likely to happen. So in this particular picture, the trend is up. The momentum is up. The path is clear. Everything has you saying it's time to look for an entry. You turn your attention to the smaller, faster chart, and you have odds favorable momentum. The smalls are above the large. The large are wide. They're angled in the direction of the trend. The synthetics are on top of the large, wide and angled in the direction of the trend. You know that it's time to look for an entry. Now it's time to define where it's most likely to happen. High probability trend trades happen from areas, fibs, mid bands, or yellow one-to-ones. And we're going to identify these areas, and we're going to let the small crowd do their thing. We're going to let the small crowd fight everything the large chart says and force a pullback to get us to those areas, to get us into the market. So we have to identify our areas, identify our triggers, but we need to let the small crowd do their thing. That pullback begins with a reversal bar on the small chart. This is when you are going to define your window of opportunity. And your window of opportunity is going to be the areas inside of those favorable large triggers. For a long trade, your window of opportunity is going to extend from the highest point of support inside of favorable large triggers to the lowest point of support inside of favorable large triggers. In a short trade, it will extend from your lowest point of resistance inside of favorable large triggers to your highest point of resistance inside of those favorable large triggers. This becomes the area where the market is most likely to continue, where it's most likely to bounce. These areas behave like a brick wall up against a tennis ball. It's a great bounce point. So when the reversal bar prints, identify your areas, your favorable large triggers, and draw that window from the highest point to the lowest point. Guys, this becomes the area where the market is most likely to continue. You're going to put a limit order. You're going to wait for the market to come to you right at the highest point of support. And you're going to do that because remember, your large chart, your large chart has odds favorable momentum. Your large chart has absolutely nothing in the way. Our anticipation is that it's not going to be able to push that far. So we're going to get in at the top of the window. We're going to wait for it with a limit order, and it's either going to reach us or it's not. We're really not in control of that. The only thing that you will ever be in control of as a day trader are whether or not your rules are met, whether or not you have the advantage of momentum, whether or not you have the advantage of a clear path. And then when you do, waiting for a reversal bar on the smaller, faster chart. Highlighting your trigger lines from the top to the bottom, and you know that your areas have to be buried within, and then coming through and identifying from the highest point of support to the lowest point of support. Guys, and this white shaded area represents where the market is most likely to bounce. Your first 20 days with Nexgen should be focused on identifying this area, being able to recognize this point where the market is most likely to continue, because when you do, great entries create manageable trades. When the market pulls down and hits your limit order at the top, you're in a trade with the advantage of momentum. You're in a trade with the advantage of a clear path. You're in a trade having entered where the market is most likely to continue, and this becomes a trade that typically wins 70 to 80% of the time. Sometimes the small crowd fights a little harder, and they may push you to the bottom of that window, and you may see your equity go a little bit negative. And when this happens, through repetition, guys, through going through and looking at this trade over and over, you're going to become comfortable with this scenario because you know that all of your advantages are still in place. However, we manage risk before we ever manage profits. We manage risk through that momentum, through that clear path, through that window of opportunity. And next-gen users are going to put a protective stop outside of that window of opportunity, 3 or 4 ticks beyond where the market is likely to continue. And you're going to accept that 20 to 30% of the time, that stop is going to get hit. 20 to 30% of the time, It's going to be a cost of doing business because anything that wins 70 to 80% of the time, they're mathematically obligated to lose 20 to 30% of the time. And I'm never going to tell you that you're going to win 100% of your trades. This is a cost of doing business. And losses are a normal part of a positive equity curve. You will find at the end of the day when you focus on this trade, if you're catching them, if you're winning that 70 to 80%, you're still giving yourself the opportunity to be profitable. And guys, this is your focus for 30 days, getting in at the best of the best spot, making sure that you understand the rules, what they look like, asking a million questions until you do, because 70 to 80% of the time, that's your result. Go into that profit target, guys. And once it starts to go in that direction, you can reduce your risk even further behind that reversal bar. Guys, this is the high probability trend trade. This is the best of the best. This is the one that gives you the advantages, that identifies where the market is likely to continue. And guys, this picture is how to study it. I want each and every one of you that are coming in here. AC Trader, I want you saying to yourself, that Novak fell is full of beans. I'm going to back test this thing. Put it through the ringer and prove them wrong. Nick, I want you saying the same thing. Because when you do that, I'm telling you right now, guys, you'll be with me forever. If you follow the rules, if you go through, if you look at it, you're not going anywhere. When you have odds favorable momentum, when you have nothing in the way, circle those tails on a large chart. Go back historically. Do it on any market, any time frame. I don't care. Circle those tails. If they line up with an area of support or resistance inside of favorable large triggers, guys, you've just found a high probability trend trade. This is your best of the best. This becomes your entry. And you can do that. We saw it when we scrolled back over here on the NASDAQ, right? Everything says down. The momentum is cranking. The area is likely to break. It has the potential to break because of all that momentum. And we don't trade tails. We trade pullbacks. So when this market says everything is down, everything is screaming to the downside, on a smaller, faster chart, you wait for a reversal bar. At the time of the reversal bar, you say this market is likely to continue from the lowest point of resistance to the highest point of resistance. It becomes the area where it's most likely to bounce to continue with the momentum. And this market pulls right up to it, and it screams to the downside because of the momentum. Guys, you can go back on any market. You have workspaces for crude oil. You have workspaces for the S&P. And if you go back and look, you can begin to identify no clear path, back and forth, no reason to ever get caught in consolidation. But when the momentum is its strongest, when the path is clear, let's see if that one set us up. Little indecision this morning in the S&P. At 2200, we pulled right back to resistance to finish the move to the fib. Guys, I want you to scroll back 10 days. I want you to study this. I also want you to see how your rules keep you safe. We knew that there were no more short trades into support, and when the market pushed up to resistance, we knew not to trade into resistance. The reaction was a push right back to support. There's one of those pivot stop outs, no momentum. Sure enough, it holds and pushes right back up. Guys, this is buyers and sellers fighting in these key areas for position. You don't ever have to get caught in consolidation. You don't ever have to get caught in what we call chop. When rule number 2 isn't met, sit on your hands and do nothing. Guys, somebody's going to win this fight. Somebody's going to give you odds favorable momentum. Somebody's going to give you a clear path. And when they do, you're going to have the opportunity to absolutely pounce on it. Same thing in crude oil. Sometimes you'll be able to just circle a tail. Scroll back a little bit. Let's see what that tail looked like when we get to it. Well, it pulled right back to resistance inside of favorable large triggers. This one overran a little bit, but sure enough, it worked. Another pull back to resistance, another pull back to resistance, all the way down when that momentum is going. And then the smalls start to return in. We get multiple divergences in the same place, and it begins to push up. The idea is that you're going to study this trade, that you're going to go back and look at it. You're going to wait for advantages. and you'll be able to catch it when it sets up, guys. You'll be able to grab that high probability trend trade. You'll be able to give yourself the best chance of success. And I'm going to give you some gifts to be able to do that. Guys, this is your high probability trend trade checklist. This is the one that reminds you of the advantages that need to be in place when you pull the trigger. You should have a good top or bottom. You should have that termination that creates a full reversal. You can take it without, but that's where you're going to use those divergences on the smaller, faster chart to make sure that things aren't changing. Guys, this is the precursor for the highest probability trend trade. This is that 70 to 80%. Odds favorable triggers on the large chart and your small chart. No termination conditions on your large chart. Area inside of favorable large triggers. Nobody has ever been able to mark yes to every one of these and do less than 70%. In the history of having this checklist, I've never seen it done. For those of you that are visual, here's the exact same checklist, defining that good top or bottom, the termination that creates a full reversal, defining odds favorable momentum, showing you when the advantage is present and when it's gone away, letting you know when areas have not been broken and the path isn't clear and what it looks like when they are, and then defining your window where the market is most likely to continue. So for you visual learners, have this one on your computer. Take a look at it every morning before you start the day. The same rules that are on the checklist are the same rules that I want you to write on your chart. I want you to create a connection visually, what each one looks like, what it means to you to get into a trade to have this advantage so that you can identify it at a moment's notice and learn to take these trades. And then finally, I'm going to give you the high probability trend trade checklist. Guys, we're going through this first hour. We're talking about the rules. We're giving you the ability to study so that you can formulate a plan that suits you. I'm going to provide you a plan in the beginning, and I'm going to give you a plan that isn't the end of plans for you. But what this is this is a stepping stone on your learning journey. I don't know what a journey is. It's designed to optimize your chances of success with the high probability trend trade and that 50-50 trade, that medium probability trade where areas have the potential to break. It's going to be through simulation, through study, through class feedback and practice that you will create a plan that's suited to your needs. And you're going to see that in this room. You're going to see people taking trades that may not fit the rules for the high probability trend trade exactly, but through study, through chart reading, through feedback, people have been able to create a plan that suits their needs. And that's my goal for you. My goal is that you're able to write a plan, that you're able to follow a plan, and hopefully that you fire me one day because you're too busy making money as a day trader. You're going to make your own, and it's going to be based on your ability to read your charts. So it all goes back to becoming a chart reader. The simple plan for consistency begins with never fight the large chart direction, never fight the large chart momentum. If you do that, you've really eliminated 60 to 70% of the biggest problems that new users face. You're going to take 20 days to learn entries. Some of you will have it in 3. That's cool. I say 20 because I think it's doable if you stay focused to be able to get into the market at the correct spot. You're still going to have to work on management, so you spend the first couple weeks. Let me just get in. Let me give myself the best chance of success. Let me take a trade from the area where it's most likely to continue because great entries create manageable trades. And management becomes the second part of what you do. And I'm going to show you this, and it's in the spreadsheet that I gave you. But as the brand new user, your entries, guys, they're mechanical, they're methodical, they're pragmatic. They remove emotion because your only option as a new user, should you allow yourself to work like this, is either rules met or rules not met. And the only way you're going to take a trade is if your rules are met. Start that process now. Once you're in the trade, it becomes manageable. And the easiest management comes from taking trades where it's most likely to continue, from those pullbacks inside of favorable large triggers. And when you do this, your initial stop goes beyond where the market is likely to continue. And this is really all you're in control of at the moment. I'm in the market, the advantages are present, my stop is where the market shouldn't go. And there's only 2 options, guys. You're either going to get stopped out, normal part of a positive equity curve, or you're going to get a reversal bar in the direction of the trade. And this is a little trick that John Novak put together in a PDF I'm going to share in a minute. If you're uncomfortable selling the market while it's on the way up, as you begin to learn the methodology, wait for a reversal bar in the direction of the trade. Wait for a little confirmation going in the direction of the trade. Confirmation has a cost. But your risk is already defined, guys. And I'm telling you, if you have trouble getting in with the market coming after you, this is a great way to kind of settle your nerves a little bit. Your risk is already established. Your new stop goes 2 or 3 ticks above that reversal bar, and it's already headed the direction of your trend. So you're going to start either with a great entry inside of favorable large triggers, stop where the market shouldn't go. If they give you a reversal bar, or if you choose to enter on a reversal bar, your new stop is 2 or 3 ticks above that reversal bar. And then once again, there's nothing to do, guys. We're managing risk before we ever manage profits, and we've done that with the reduction of risk. You're going to sit on your hands and you're going to see what the market does. It's either going to stop you out for a small loss, or it's going to hit your first target. For my brand new users, your first target is a measly $100, right? And a lot of you are like, I don't want to take a $100 trade. That doesn't make sense. But if I walked up to you on the street and handed you $100, you'd be stoked, right? Guys, trading is no different. That $100 is success, and confidence comes from the memory of success. That $100 is in your account. Nobody can take it from you, simulated or otherwise. That $100 feels good. Serotonin's flowing, the dopamine kicks, and you're going to move your stop to break even. So now you got paid, but you also have no risk. You have absolutely nothing to lose in this trade. And this is designed to help train the new user's brain to believe in the advantage of momentum, to believe in the advantage of a clear path, to be able to sit on your hands and do nothing and see if we can get to that second target because you've been paid and there's nothing to lose. And guys, if you get to that second target, it's only at $200 for the new user on this super simple plan. And that on 2 contracts, should you hit it, is a $300 trade. 300 feels better than 200. 300 once a day, every day, is a $1,500 week, guys. That's a $6,000 month and a $72,000 year on a base hit. Not too shabby, right? What happens when your profits up your contracts? You don't change your trade. You don't change your plan. You just go to a 4 lot instead of that 2 lot. Suddenly, the exact same trade with the exact same pragmatic management is $144,000 a year. And it still revolves around the advantage of momentum, the advantage of a clear path, and the advantage of entering the market at the absolute best of the best spot where it's likely to continue. Guys, I'm telling you right now, this KISS plan is designed to get you into the market at the best spot. It's designed to get you paid quickly, to get you confident, and to turn you into a chart reader. As you grow, your simulation, your study, your feedback, and continuous practice is going to change that management plan. Every great trade creates or every great entry creates a manageable plan, a manageable trade. Um, and I'm going to show you your chart reading. Every great entry creates a management opportunity. You'll start taking pictures where you get in at the absolute best of the best spot, but because of the momentum on your large chart, because of the clear path on your large chart, you may make the choice to put your final contract down there at that fib. And this is kind of the first step. You still get paid, but because of the momentum and a clear path, it creates an opportunity for larger profits. Um, See it again? Everything says down, the path is clear, the momentum is the strongest, the entry is perfect. Eventually, you'll hold that next contract to Fibonacci support. You'll turn your $300 trades into $500 to $700 trades, and you're just going to compound that through contracts. So that is your high probability trend trade, guys. That is your best of the best. That is your opportunity to be consistent, to find success, to create confidence. I'm going to put that in the room. And this is where I encourage you. If you're brand new, try not to deviate. Focus on the best of the best. Give yourself that solid foundation to grow from. Get to the point to where you can identify odds favorable, where you can identify the clear path in a moment before you start going beyond to that next trade. And then add the next trade. Get good at one thing before you go to the next. And guys, that's crude oil. The smalls have broken, but the large have not, meaning that I've reached an area with the potential to break, but it hasn't broken with that momentum. Over here, no divergence, strong trigger says, if you want to take a shot at it, go ahead. That follows the KISS plan. And once we start sacrificing momentum on these 50-50 trades, what is divergence? Divergence means a loss of momentum. So now the path isn't clear. And now you're giving up momentum. And now you go from medium probability to low probability. And look how the market reacts. It's pushing down. This pattern right here, especially on a 50-50, a lower divergence, is huge for identifying when that 50-50 is less likely to work. And John Novak created this PDF. I'm going to share this with you as well. Guys, this is kind of taking everything that we just talked about and putting it into a fast track guide for you folks that are looking for both high probability and medium probability trades. It still revolves around embracing the advantages on the large chart. That never changes. You're always looking for odds favorable momentum, whether it's an uptrend or a downtrend. You're always looking for pullbacks to areas inside of favorable large triggers, whether it's an uptrend or a downtrend. But what this PDF does for you is it discusses those two options. Entering at the area or waiting for a reversal bar. Neither is wrong, right? One gives you established risk, the other one gets you in probably with the least amount of risk and the most profit potential. But as your brain gets okay with the patterns, it becomes easier to get in at the area. It also talks about holding for larger moves, trailing stops. It gives you a little bit in that direction. It goes on to talk about recognizing when the trend may end. That's that termination condition using a smaller, faster chart. Trend trades that don't work. It gives you more scenarios to think about, more scenarios to practice with, more chart reading as you grow to just extend your plan. And guys, that's one of those potentials to break, but it has problems. Potential to break, right? But divergence prints. And here we have the potential to break. 1, 2, 3, 4 divergences in the same location lets me know that it may push up further. And I don't know if it's going to be a mid-band or a fib or a mid-band or a fib. They're trying to break out of a range on the S&P. I'm going to let them break. Guys, give me a Y in the room if you can see how clearly defined this problem area is. From the lowest point to the highest point, termination conditions all day long. Doesn't it make sense to let them break out of the area rather than hope that the area breaks? Doesn't it make sense to not fight multiple divergences on an edge? Doesn't it make sense to not trade into Fibonacci resistance? Guys, this is where you have to really squash your fear of missing out, where you really have to squash your desire to predict or to hope. And just sit on your hands and do nothing. And that's going to be the most difficult part of your day trading. The software is the best in the world. The education's really solid. The methodology has been proven year after year after year. All you have to do is tell yourself, I'm only going to trade when my rules are met. And when they're not, I'm going to sit on my hands and do nothing. We're going to take the next 2 hours, guys. We're going to look at the trades that you've posted. We're going to look at the questions that you post. Lecture time is over. It's time for discussion. So all of these new names that I'm looking at, I want to hear from you. I want to hear your questions about momentum. I want to hear your questions about termination conditions. I want you to say, hey, Mark, let's go find entries. Let's go find the best of the best entries and let's talk about them. Let's look for momentum. Let's look for those tails. And let's look and see if they pull back to support inside of favorable large triggers. Let's back test and see what we can do to create recognition through repetition. And let's get to that goal of becoming a high probability trend trader. Guys, look at that. Potential to break. 3 divergences in the same location. Pretty outstanding. So guys, I'm going to take 5 minutes. When I come back, I'm going to scroll through charts. We're going to do it in order that they were presented. If I ever miss a question, if I ever miss a chart, guys, do me a favor, let me know. It's never intentional. I'm going to take 5 minutes and stretch my legs. Guys, maybe do the same thing, right? The more you look at a chart that isn't giving opportunities, the more likely you are to try to fabricate one. So run a lap. I'm going to do the same. I'll see you guys in 5 minutes. Later, glad you made it over. No worries, man. All right, so first half of class is all about rules, right? First half of class um, is really just talking about the rules. And I'm telling you right now, this first half of class, guys, it is your one-on-one session. This is you and I having a conversation. This is your private session, learning the rules straight from the horse's mouth, making sure that you get everything that you need to be successful. The second half of any private session is you presenting pictures, right? And when you present those pictures, it gives me the opportunity to present feedback. So what I'm going to do is I'm going to scroll up to the very top of the day. We're going to get to the earliest charts, take a look at them, and I'm going to bring them up so everyone can see them. And then from there, we're going to talk about advantages. We're going to talk about the advantage of momentum. We're going to look for the advantage of a clear path. And we're going to talk about entries. And not all entries are going to be high probability trend trade entries. For example, this is the NASDAQ and this is Bobby. And Bobby sees the potential for an area to break. And he's looking for this little bit of momentum, right? In the small triggers, looking for that separation. And he says it seems to always go at least 5 or 6 bars on the large chart, which means that it gives him an opportunity to hop in and to make money. This is not a high probability trend trade. This is a momentum based trade. This is embracing the idea of areas that are likely to break, that have the potential to break because of momentum. This is letting problems clear on a smaller, faster chart. And this is respecting Fibonacci support for exits. And this is an outstanding trade by Bobby. This is a momentum style trade. And this is what chart reading is going to do for you guys. You're going to begin to recognize things. You're going to begin to test theories. You're going to be able to say stuff like, I've seen this 100 times because of the pictures I've taken, and I think I found a way to utilize it to my advantage. One I took this morning is very similar. It revolves around momentum. It revolved around a clear path. I took an entry. That was $400 in about 8 seconds. Thanks, Ron, for helping me out with that one. And then Miss Debbie comes in and she says, you know what? With odds favorable momentum, with everything going in the direction of the trend, I'm just going to sell a pullback to the areas inside of the triggers and make money all the way down, guys. And this is more using that high probability trend trade and in embracing the idea that when everything says down, when everything is screaming, to just take a trade and make a little money on it. And Debbie does it well. And one of the things, she's not here right now. I told her that her ears would be burning. If I look at the last 20 trades that Miss Debbie has presented in this class, they all look the same. If I look at the last 20 trades that Ron has posted in this room, they all look the same. And the one common thread between successful traders and not quite where they want to be yet traders is that successful traders tend to focus on one thing that works really well, maybe two things that work really well. And instead of looking for all the trades, they're very adamant on doing absolutely nothing unless they have the absolute best trade. So I love seeing the consistency. Smalls below the large are wide. Notice that every trigger line is below that area of resistance. There's a pullback. And Debbie takes that a little more conservative, little close on the correct side of the small triggers, and it really creates an effortless trade for her. And then David says he had this killer trade yesterday, and then he went right back to chasing this morning. It's normal, right? David, this is awesome. Everything says up. You take the pullback. Look at that entry. David, I think we figured out your entries, right? Waiting for that pullback, putting the two charts together. And it goes all the way up to Fibonacci resistance. No worries. David, the only challenge, and I'm obligated to point it out, is that you were flirting with trouble just a little bit at those one-to-ones, right? You were flirting with trouble. But every chart said go. Every chart coming from a good bottom. You had a medium probability trade. You were wagering based on your entry area, based on everything going up, that you were going to get that next fib. And I think you did it wonderfully, David. Nice job. Notice that the backgrounds are green. Traded a pullback, which reduced your risk, increased your profit potential. So even if, David, this problem area decided to stop the market, you had room to make money to it. You had room to get break even. That's outstanding. These are the things that excite me as an educator, guys, is when I see people that are taking these lessons, that are working on them, that are asking a million questions for clarity, and then they show me a picture where it all kind of comes together for them. And David, you'll calm down with repetition. You'll start taking trades because the rules are met, and you'll have this feeling that you're like, man, I don't have to look for other stuff. And then Nick, everything says up. The momentum is screaming. The termination condition caused it. You got in at 54. I can't see it on your small chart, but you're just taking that momentum style trade, Nick. And I think that we found your baby here. Not waiting for the pullback, just saying, I've got room, right? Everything green, everything is strong, everything is up. And then your second contract is off at resistance. Nick, nice trade. This trade is the absolute reverse of what Bobby did, isn't it? But that's not it. There's Bobby's trade. Same look, right? You just caught it going up. Momentum and clear path leads the way. Dude, Nick, rockstar, dude. Welcome to Nexgen. You, my friend, are hooked. All you got to do is see what suits you, right? Learn how to read your charts and what suits you. And look at this. Tony, momentum, same thing. Everything says up, the path is clear. Why not get paid a little bit? Telling you guys. Here, Nick, a little bit of overrun, right? 50-50 doesn't run, three divergences. That's a good looking top. Do you see the other side of it though, Nick? Do you see support and none of the trigger lines are through it, right? So Nick, in the moment, this support is likely to stop the market. None of your trigger lines have broken. As much as this is a termination, this is an even stronger termination. And let's go to crude oil. Look how support holds, right? And then it retests resistance. And now it's starting to push down. And it's got a little more of a fighting chance. Rule 2. Rule 2. Rule 2. Rule 2. You got to come up with a new trade, Ron. But do you see how that works, Nick? You don't have to guess and hope. Let it clear. One of the reasons that this first trade was so successful is you notice how you've cleared the areas. You're gone to the areas. You haven't reached the next area. You had room to run. On this one, you're right into an area that's likely to cause a bounce. Does that make sense, Nick? Excuse me. Big difference in the look. And this is where repetition comes through. Yeah, patience is the hard part, I think. And then Snorri, let's see what you got, bud. Snorri, you have a clear path. We're starting to weaken that momentum. You take the rock star entry, get paid on the first one. Oh, you just took it off on both. I like it. This was the only trade you took yesterday. Wasn't going to trade, felt jet lag just watching, but you had to take this one. Just a quick $200. Entry was a bit outside of the triggers, just a shade, right? That's the one. And then Snorri, I'm assuming that you knew that it could have been this fib or this fib, right? Probably had a stop up here initially where the market shouldn't go. It's a beautiful trade. That's a hard one not to take. And I like it. Just quick profits, right? We're in this to get paid. And you did that exactly. And guys, I'm assuming the market's not giving a whole lot today because that's it for the pictures. That's all we have right now, which is kind of cool because it opens up the door for you guys to ask a million questions. So what's the read on crude oil? They tried to break and couldn't, pushed it all the way back to support. The buyers pushed again, but the trigger lines didn't blink into resistance. Everything's pushing down. Nick, if you caught your entry there, you just reached a potential profit target, right? Ron might have taken a couple bucks there. Just hit it. Trading with momentum and direction. Clear that path out, and it's easy, isn't it? It's crazy how that works, guys. And all you have to do is learn how to recognize it. Support holds. Trades right into resistance. Nothing to do, right? Do you guys see it? Don't go short because the triggers don't break. Don't go long. Your large triggers are still down. Give it a second. Let it sort out. Let it figure out what it's going to do. There's a termination that creates a full reversal. The full reversal gives you the momentum, but 4380 hasn't broken yet. And there's two divergences against it, so I don't have a clear path, and I'm losing momentum at a pretty alarming rate there. And then Jose, momentum style entry. Momentum in, momentum out, right? And I think that is the biggest thing on momentum, is if you're going to take momentum in, you have to take momentum out, right? And a reversal bar on the wrong side of the small triggers, this might save you a couple ticks here and there. But it's a good top. It's strong triggers. And that's the perfect momentum entry, Jose. I like it. Those are designed to be little snippets, I think. Your large chart, your 21 said, hee-hee, that's your trouble spot, right? 77.87 is right there where that market bounced. Indecision on your range chart. I love the way you handled this one. Not willing to give it back. Nice job, Jose. I personally, I don't care for these trades. That's just me. Especially when my large triggers are up here. We'll see what happens. Notice how it closes the gap to the large triggers, Jose? They were a full bar away. That's when this one is less likely to work. Guys, this is the gap theory. We're going to talk about this, because it's a good lesson. And this is going to help you, Nick, as well, as you start looking for things with these momentums. Guys, even from a good top, when price comes down and accelerates away from those large triggers, yeah, it's a 50-50, Jose, but it's still the gap theory. So with those large triggers a full bar away, there's literally nothing to do between here and there. Let it close, right? So, where did yours go? Large triggers are all the way up here. You're taking the quick little snippet, but yeah, once you get that reversal bar, nothing to do. No 50-50 trades, divergences are printing, but more importantly, that gap theory was in place, and look what it did. Closed the gap and absolutely rocketed it up. So guys, what the gap theory is, let's talk about that. Nick, this is going to be important for you on those momentum style trades that you're looking for. What the gap theory is, this is when mid-bands can become termination conditions on the large chart. 3 to 5 ticks. They don't always, Nick. I'll never say always. I'll try to never say always, because sometimes they don't. But remember that trading is about advantages. Trading is about having an edge each and every time you take a trade. So if we can recognize the pattern that says if price pulls away from those large triggers really fast and far and smacks into an area, fibs, it can also be mid bands. It's like a slingshot. Price accelerates away and then it just snaps back and it hits. So if price accelerates away from those large triggers and smacks into a mid band, this box, this whole range, there's room for a full bar to get back. I'm not taking any short trades in this area because it's likely to snap back and hit it. And you see it again here. Price accelerates, hits those areas. The large triggers are a full bar away. It's likely to snap back and close that gap, likely to snap back and close that gap. And there's a picture of what just happened, right? Comes all the way down into Fibonacci, overruns it a little bit, but the large triggers don't follow. It's likely to close that gap. And it doesn't say go long, but what it tells you is, man, don't go short. It's likely to snap back and close that gap. And you'll see this a lot. Um, Price reaches resistance, large triggers are a full bar away. It closes the gap. No long trades. Price reaches resistance, large triggers are pretty much a full bar away, snaps back and closes the gap. Overruns, snaps back and closes the gap. There it is into resistance, snaps back and closes the gap, like over and over and over. Yeah, always is a very dangerous word. But if you just scroll back on a chart, you'll see how many times this pattern repeats itself. And it just, like everything we do, it creates a safeguard, right? Because that's a termination that created a full reversal that gave you odds favorable momentum. But when you smacked into that mid band and the large triggers didn't follow, it keeps you from hoping that the long works. It keeps you from fighting that gap theory. And this is a super common occurrence, really on every chart. So Jose took that one little stab at it, and then it didn't work out. So he just sat on his hands and let it close the gap. There's that downtrend, there's that momentum, there's that path clearing, and there's that pullback to resistance inside of favorable large triggers. The path isn't 100% clear, but it has the potential to break. Notice the strong triggers, notice the tiny window of opportunity. That's a good looking trade, especially coming from a termination condition that creates a full reversal. And then, Nick, there's your clear path, right? That's the one you're looking for with momentum. Jose, there's your momentum trade. I can find everybody's trades in here. Ron got short. Maybe 60. He'll be out at 50 or 49. The cool thing about this is I start to understand what all you guys are doing. So not only can I help refine it a little bit for you, but I can also give you a nudge if I find that you're straying from your rules a little bit. I see that pattern. And then Gene, absolutely beautiful. Two divergences, resistance holds, everything down, momentum is there, and you're like, you know what? Give me a pullback. We're going south. Outstanding. Do you guys notice how every indicator on Gene's chart agrees? Everything is red, everything is strong, everything is down. The difference between Gene and you, if you're brand new, is that Gene's been looking at this for a few months. Gene's been studying these patterns. Absolutely, David. How techie do you want to get? So let's talk about the difference between a one-to-one and red and blue. AC Trader, it's great to have you. Welcome to day one. AC Trader, can I share the most valuable? There is no difference in strength, David. And this is a very common problem, is people try to assign strengths to things. It doesn't. When we talk about fibs and one-to-ones, David, there's only, because they are different, right? And I'll show you why. In AC Trader, I wanted to show you this picture. This is my favorite picture for new users. There you go, AC Trader. There's day one, my friend. I promise. It's like this for everybody. Day two, you're like, oh. Day three, you're like, wait a minute. By the end of your first 3 or 4 days, you're going to have a couple realizations. You're going to realize, one, that the software does work because the people that have put the time in are showing you the same winners that I teach every day. You're going to understand that the education is focused and it's focused on your success, and that you do get feedback every day. You won't be a professional day trader by the end of the week, but you will understand that you will have the tools to become one with a little bit of study, practice, feedback, all that good stuff. So, David, let's talk about fibs and one-to-ones. So, what are Fibonacci? And I think that this is a great lesson. And I'm not going to lie, it shouldn't affect anything. It shouldn't affect your decision making. It won't affect your rules. It really won't affect a darn thing. But for the sake of knowledge, I love it. So when you open your software, David and everybody else in the room, your T3 software, it analyzes data set up for the last 10 days, and there are literally thousands of individual calculations, Fibonacci retracements, alternates, and your software doing all those calculations creates thousands upon thousands of areas and lines and measurements. The magic, and man, I never knew my brother was this smart. The magic is that it weighs them, it sorts them, it figures out which is the most important, which has the highest concentration in Fibonacci levels. And then what it does, David, is it creates those very concrete areas of support, areas of resistance, and it does it through all of these thousands upon thousands of calculations. So when we talk about areas, we talk about Fibonacci areas. From all of these calculations, David, you're going to get very concrete areas of support and very concrete areas of resistance. But they are areas, right? It took 1,000 calculations to create this red line, so it may go a little bit over. It may stop a little bit short. And that's where we use the trigger lines to determine whether it's likely to hold or likely to break. So for one-to-ones, while fib lines are designed from areas, from thousands of areas to create that red and blue line, what a one-to-one is, David, is it's one calculation. It's in the moment. It's like fibs that print in the moment. Your software still runs calculations. It still measures pivots. But when it gets the formula met to create a one-to-one, it'll begin to print them real time. So what this is, David, is it's a 100% Fibonacci alternate. It's still a fib, but it's a fib based on one calculation, one set of measurements. It's in real time, but it's not stronger than one of the areas. It's not more valuable. It's not weaker. The recipe is still the same. If price reaches it and the triggers remain below it, then we're not taking that trade. Absolutely. If you have a line on your large chart, price reaches it, triggers don't break it, sit on your hands. Whether it's a fib, whether it's a divergence low, right? Simplification. 100% simplification. Don't overthink it. Losing a little bit of momentum, but the path is clear. Guys, this is one that gets new users. Two divergences in the same location, weak triggers, and none of your areas are inside of favorable large triggers. Can you guys give me a Y in the room if you see this? Hey, Fern. It still looks good here, right? The path is clear, the smalls are outside. But we're noticing change on the smaller chart. These are your areas. These are your favorable large triggers. They're not together. So not only are we losing momentum, we also don't have areas inside, which means we don't know if this is going to continue down. And if it does, where's it going to continue from? Hell, I have no idea. So I'm not taking a trade because my rules aren't met. And Ron reminded us, Crude oil inventories just came out. They're talking about the reserves, and we'll see what happens. Tony the Tiger taking a snippet. Everything says down. Quick entry. Oh, that's the one that I pointed out. Nice job. And just getting out quick. Money, money. Nice job, Tony. I like this. It's just quick. You're like, God, I don't have to make $1,000 every run. Daryl, you're missing the bottom fib. I didn't have a bottom fib either, did I? Who had a bottom fib? But does it make sense? Not your odds favorable, right? It's still momentum, but it's not the best momentum. Then your small chart's already 2 divergences and weak triggers, and none of your areas are inside. Just tiny little subtle problems through chart reading. Fern, welcome to the classroom. Taking pictures of my pictures. I love it. Fern, keep posting pictures. Daryl, does that make sense though? Awesome. This is for me, guys, one of the patterns that I recognize, and it's not always true. The further below my areas my large triggers get, especially if these are weakening, it's hard to make a guess on what it's going to do. And I hate making guesses. I just like to have advantages. And then Gary, good top, momentum. I'm not sure. 15-215, 15-215. It's hard to line up, but it looks like you traded directly into support that just held, which is cool if that's what you want. And you get out at a mid-band, and you get out again, and that momentum predicates everything. Not quite an HVA. It means that there's just more going on, Nick. Absolutely. So during news releases, you'll see those big spikes, and they become difficult to trade. Gary, nice job taking advantage of the top on that one. What do we think, guys? Weaker triggers, large aren't through. 1, 2, 3, 4 divergences in the same price range. For those of you that are brand new to Nexgen, check this out. This is pretty cool. I'm going to circle, whoops, this one bar on the large chart, that one that we're looking at on the large chart. Look at how many bars are inside that one bar when you get to that smaller, faster chart. Guys, this is your refinement process. This is where decisions are being made at Fibonacci, right? The large triggers don't break. Things start getting weak. Advantages go away, and you guys don't ever have to get caught in these. The buyers rocked it all the way up to that 87.20 area, and you can see the momentum being stolen. You can see the indecision. You can see the areas not being broken. Thank you, John. And now we're directly into that support. And we have the gap theory in place. So here's that gap theory, guys. Let's see if they want to close the gap to the large triggers. If they do, we can expect some sort of retracement up to here. New users, do you see it? Price reached that Fibonacci support. No short trades into it. And those large triggers are all the way up here by that reversal bar marker. It might come up and close that gap. We're going to find out in just a second. What it means for me is I'm not going short into support. None of my trigger lines have broke. I'm probably not trying this little momentum trade off the mid-band because of the gap theory. It's likely to close that gap. And because this wasn't a termination condition up top, what we may find is a market that wants to just simply continue up. Look maybe for those one-to-ones up there. The one thing that I've resolved myself to is I just don't know. I don't know if it's going to close the gap, or I don't know if the area is going to Do you see this white line right here, Nick? That's your reversal bar marker. That is the point at which this bar becomes a reversal bar. So if my large triggers are above it, it means that I have room for a full bar back to them, which means that the gap theory is in effect. And we'll see what happens. And it may or may not, right? But we scrolled back and we saw about 10 instances where that gap got filled. And when it's coming from a bad top, meaning that it's not a termination that creates a full reversal, it's more likely to get back up there to retest it. And again, it's never guaranteed. And like John said, always is a very dangerous word, right? But it gives you that little patience piece. It gives you that little piece that says, hey, this is a pattern that repeats itself nearly every day. This is a pattern that takes away an advantage. This is an opportunity for me to do very little in the moment because I'm just not sure what's going to happen. Um, isn't that cool? I used to think my brother was magic, guys. I'm not going to lie. I used to go short right about here. And John Novak would say, guys, gap theory in effect. Because of this bad top, because of this support, because of the room back to the large triggers, this is a huge decision-making point, guys. Either the sellers are going to come back and keep pushing down, or it's going to run up. Tony, on the 5-1, it's usually gold. Do you have the gold bar? Or are you trying to get, oh, you've got, oh, I see. You want the 13-2. Gosh, I think it's just in the template. Five one Rinko 2023. Let me reload the template real quick and let's see if it's on there. If not, we'll do a little research. Yeah, it's on there when I load the template. You could try reloading it, see if that works. If not, there's got to be a setting, right? Reversal marker 1, false. Reversal marker 2, true. So I think it's reversal marker 2 that you would put on there, Tony. And then check it out, Nick. Is that freaking amazing or what? When the market was all the way down here, we said that it was likely to come back up here. And sure enough, patterns hold true again. Rule number 2 keeps you from getting married to the shorts. The gap theory keeps you from trying it too soon. I love this stuff. It just absolutely amazes me. The more you read your indicators, the more you're like, holy crap, this stuff is good. All you have to do is learn how to use it, guys. It's the greatest hammer you'll ever buy. Once you learn how to build a house with it, there's no stopping you. Pause for effect, right? So we'll let crude do its thing. NASDAQ is just falling out of bed. So's the S&P. All right, show of hands. How many of you said, dag nabbit, didn't get my entry? I bet there's a lot of you. They were like, son of a gun. They just didn't give me the pullback. But Daryl, you knew where it should have gone, right? You knew where it should have been. It just didn't get there. It's that nasty phrase, guys, not my money. Rude market. It's just not your money. If your rules aren't met, guys, it's just not your money. And you got to be cool with that, right? You got to be cool with the idea that every dollar to be made in the market doesn't have to be yours to be successful in the market. Every move doesn't have to be your move. Every look doesn't have to be your look. The idea is that you have a statistical advantage every time you take a trade, right? Every time you set up for a trade, As a brand new user, you have momentum, you have a clear path, and you have an entry area. That entry area may be an area inside of favorable large triggers. That area may be just the clear path below it on the small chart. That entry area may ultimately be a high volume area line as you incorporate the market flow charts into what you're doing. But the advantages never go away. And no matter what trades you show me in this room, we're always going to go back to these because this is your chart reading. This is you guys being able to take the information that your indicators are giving you and really just running with it. D-Rock, you say not good trading today. With two divergences, it is okay, right? Um, and we kind of talked about this one in the moment, D-Rock. That's a great look, dude. It really is. This one here was probably a better look. Do you see the difference in the trigger lines? Do you see the difference in where the areas ride? I really do think, guys, this is just me. Sometimes we skip the first one and try to catch the second one. And these weak triggers and second divergence really said that it may push higher. And sure enough, it did. D-Rock, I don't think it's bad trading. So let's not call it not good trading. I think it was solid trading. It didn't work. And then this one, man, you just got caught up in a range there, right? You're one tick off, 50-50, great momentum. D-Rock, what's your rule on reversal bars for management? Did you choose not to on that one? Did you change your plan on that one? Or were you worried because you were too tight the other day? Because that happens too. But at this point, D-Rock, you got an 82 stop, and that turns it into a super tiny loss there. Using that reversal bar a little bit. But again, it's a good look, man. It's a 50-50. This area has the potential to break, and that is your absolute best momentum, and there is no divergence, and that's a tiny little window of opportunity. And somebody knew it too, right? And that created that little bounce to make it manageable, and then it just came through, and you're a little frustrated, and man, I get that. Guys, I'm going to tell you right now, trading is an emotional roller coaster. And the more that you trust, your rules, and the more repetition that you have. And D-Rock, what you're learning right now, about 30 days in, is that the market, some days it's amazing, and some days it's a butthead. Some days it's rude. Sometimes it doesn't give you your entries. Sometimes it's this bitch goddess that makes you believe everything is wonderful, and then it just kicks you when you're down. And it's just part of it, right? So no shorts. And now we're at a termination. Now we're at a pivot stop out. Now we're at support, right? The triggers are split. Do you see how this one's trying to tempt you though, D-Rock? You're saying, oh, no divergence. And it looks like a 50-50, but I'm not coming from a good top, right? And I have split triggers, which means that the window is huge. The mid-band's stuck in between. But 2 weeks ago, D-Rock, you were short at 96, weren't you? Wondering what the hell happened. But now you're looking at it, you're going, that barely made it through there. Those small triggers, that's ugly. Split triggers aren't favorable large triggers. That's not a good top. That's not a termination that created a full reversal. This is the market making decisions in between fibs that I don't have to get caught up in, that I don't have to hope this area breaks. I can just let it break. And guys, I'm telling you, patience is the hardest lesson as a day trader. Patience, doing nothing when there's nothing to do. I'm not saying go long, but I'm saying that's not the best look, guys, because decisions are being made not only at the blue fib, but also at the cyan divergence line. So as you grow with the software, you're going to see things and you're going to be like, oh, this is perfect. And then we're going to look at them together and I'm going to talk about these things that I have from 3 years reading the indicators. You'll be like, oh, wait a minute. I didn't notice that the triggers were split, that my area might have been huge, that my small triggers really didn't smash through. They kind of eked through. This is like a gopher sticking its head out and Bill Murray trying to get him with dynamite, right? This bad top into support, into a pivot stop out. You guys remember that circle we drew at 1033? Is it possible that they're going to go chase that area? Absolutely, Cream White. So Dwight, guys, you saw the lesson, right? Fibs are areas, one-to-ones are perfect. What's a divergence line? And I actually have a picture for this because I think I've had this question so many times. This is the most ignored termination condition, guys. Cyan divergence low, magenta divergence high. So anytime, whoops, hey, where'd I go? Anytime the market has a divergence low or high, that represents a specific, an exact point in the market where not only could the in control force, like sellers in a downtrend, buyers in an uptrend, not push any further in the direction, but they also lost momentum. The other side took their momentum from them. And it really is, it's like a line in the sand. And they will often try to exceed it again. So this is where you get those pivot stop outs. The sellers were cranking and they're like, we want this market to go down. And the buyer said, you know what? Not happening, dude. I'm going to take your momentum. And the buyers pushed it all the way back up to those large triggers. Hello, gap theory. When they did, the seller said, guys, we really want this to go down. And this cyan line is where the buyer said, come on, guys, we told you. We told you we don't want you to go any lower. We're going to let you think you got it, and then we're going to shove you right back up, right? But the problem is they shoved them right back up to where the sellers said we really want it to go down. So you get caught in this fight. The sellers said we're going down. The buyer said we're going up. The triggers don't match. Guys, you don't have any advantages in the moment. Not a one. Ooh, but look at that. The sellers stole their momentum. And now they're right back at this key area. What an amazing fight that you guys don't have rules met and you don't have to be in the middle of, right? I didn't try to go short here and I didn't try to go long here. I just said, damn it, let them fight it out. I really do. I think of this stuff like a video game. Tony, putting on a clinic today. Everything says down. You have momentum. You get in below the one-to-ones, and you get out at the one-to-ones. All right, Tony, at this point, I feel like you're just showing off, right? Not really, man. Show off. Let it break. Take a chunk. Get the hell out. Get paid. Go buy a boat. Swing some golf clubs. And guys, the one thing that you're going to find is that your good days are typically rules following days. Your bad days are typically when you start to deviate from those rules a bit because you form opinions about areas that might break. You form opinions about areas that might hold. Rule number 2 said no, no shorts. Rule number 2 said no longs. Rule number 2 said no shorts. Rule number 2 said no longs. Rule number 2 said no shorts. Rule number 2 is telling you right now, come on. I showed it to you 5 times. Are you bored? Take the long. Are you anxious? Take the short. Little devil on your shoulder. Your rules are just, they're more like suggestions, right? It's like parlay to the pirates. Can anyone besides me clearly define the range that this market has to get out of before I'm willing to give it another shot? Anybody? Do you guys see how that patience? This is your 90%. Somebody's going to win. And when they do, when they give me odds favorable momentum, when they give me a clear path, I'm going to jump on that mofo. And I'm going to take it. Ah, terminations again. Why didn't my long work? Because I reached a fib. Why did this long work? Because I had room to my target. You guys see it? See the difference? Room to the target. Financial suicide. John says with a clear path, not the best trigger look, he'll wait for a reversal bar to take an opportunity. When he does, he'll manage accordingly. See how his areas are outside of the small triggers? So instead of hoping it holds, he gets a little confirmation with the reversal bar. John, I think that is awesome usage of that reversal bar marker. And now we're into that second low divergence. He has zero risk on the trade, probably took some profits. And the clear path wins. And if we talk about the most basic termination condition rules, price retraced to Fibonacci resistance, right? Every trigger line remain below. That's an area that's likely to stop the market. Yep, and I was right. He took half off. And since he doesn't know, he's going to get paid. Great trading, John. I love that trade. Bingo at 64. And for you new users, bingo means that this guy got paid at 64. Why 64, John? I don't see fibs. I don't see mid bands. I don't see one-to-ones. I don't see any reason to exit the trade. Are you looking at a different chart? Because I see 61.75 as a good spot. But without that momentum, just curious. Guys, I love hearing what you're doing, even if you're my brother. Is it high probability? Not really. Yeah, purple one-to-ones. Thanks, Jose. The areas are outside, right? But the path is clear. The trend is down. It's a medium probability trade that he managed beautifully with a lean towards medium high. And now we've gone with the stovetop theory. Not enough to boil it, but hot enough to make it burn your mouth. Why is it medium high? Because this termination, guys, once again, terminations for the win. The market absolutely danced in this range, and then they got to where they wanted to go and shoved it like a mofo. That's a technical term. Wrapped through everything, broke that area. Everything says down, and John just looked for the most likely spot to take it. And since he didn't know if it was going to go from here or maybe from the mid band, he waited for a down bar. A little bit of confirmation. I love everything about the trade. But it's all based on a chart read. Ooh, there's your crude oil. Thank goodness I didn't make an opinion. And guys, then there's that NASDAQ. NASDAQ and the ES move similar a lot, right? There's that odds favorable, pull back to a mid band, pull back to a mid band, and it makes it to the fib. The area was above the large trigger, so the down bar is a good idea. Perfect. I agree 100%, John. Nice work. And look at this, guys. With all that momentum, it hit Fibonacci support. Look at the instant reaction. Instant reaction. If you don't think these fibs are powerful, guys, from fib to fib, get paid in the middle. That's it. Get paid in the middle. Get paid where they're not making decisions. Because you're not in charge. Here's my brother's favorite picture. Who's in charge? Big money investors. Anybody familiar with remoras? Big money investors, guys. Institutional traders. The guys that are trading thousands of contracts. They create the trend. They establish the momentum. They react to the areas that you know about hours in advance. Those key Fibonacci areas. Our job is to be the remora. Our job is to let them get it done, to let them do all the hard work. And when they've done all the hard work, We're going to jump in and capitalize on it. And then we're going to get the hell out before they start making decisions again, right? We knew that this was a decision-making point. We knew about it for the last hour, or last 7 minutes, I guess. We knew this was a decision-making point. So it's kind of cool. Actually, it's more than cool. It's unfreaking believable. Still going down. John Novak, do you have any regrets about getting out at 64? Nobody ever said, "Ah, doggone it, I made $1,000, but I could have made 1,200." Son of a gun. It's that greed that forces you into bad decisions. How we doing on crude oil? Does anybody have rules met yet? Who took a shot? Who said, "Man, I'm so smart. I know it's going to go up. I know it's going to go down. I know." Just been sideways, right? So guys, I like it when this happens. It's difficult because I want you guys to see trade setups, but I think this is one of the most important things that you can ever see, guys. Rule number 2 kept you out of 7 or 8 losers easily. And if you traded the market in a previous life, how many times did you get beat up in a channel? How many times did you get beat up in consolidation? You can clearly define where it's happening. You can clearly define when you don't have the advantages. And guys, honestly, you can keep yourself safe. It's the people that try to beat the system. Well, I don't have odds favorable momentum or a clear path, but I really think I should go long. Well, I didn't smash through the area, but it sure looks like a short. I think I should have been able to go short. Well, resistance held, I'm going to go short. Oh no, support held, I'm going to go long. Opinions are expensive, guys. Opinions are expensive. Straight to Fibonacci support, absolutely no trigger lines break. Sit on your hands. And then if you're trading that clear path downtrend with a reversal bar, you're in with established risk, trying to get to that next area. But this is an exhausted move. You're getting those anything can happen triggers. You're getting those weak triggers. Not a high probability trend trade. So guys, I'm going to take 5 minutes and go bug the crap out of my wife for a second, stretch my legs, get my back stretched a little bit. If you have a question, I want you to ask it. If you have a comment, I'd love you to make it. If you're brand new with me, and this is for you guys like AC Trader, like Nick, take a picture of a chart and just tell me what you see. Doesn't have to be a trade, doesn't have to be a termination or odds favorable. Take a picture of your charts and tell me what you see. Tell me what you think, and let's turn it into a chart read together. Because ultimately, that's the goal, guys. We want you to become chart readers. So I'll be back in 5. If you need anything, post it in the room. All right, y'all, let's get into this third hour. Weak triggers, weak triggers. It could go up. It could continue down. Isn't that funny how without momentum it may go up higher? John Novak knows that. He waits for it. He gets into the best area. If it doesn't go, he's got virtually no risk. Break even's cool, isn't it? Break even happens. Taking a shot at finishing the move. Weak triggers pushed it higher. Lack of momentum, guys. That's why momentum is rule number one. 30 minutes of narrow range support resistance. Good time to just sit out. Yeah, Nikki P, this is what we call a making a sandwich pattern. Or a text your sweetheart and tell them you love them pattern. Or a walk the dog pattern. Or if you're Ron C, go get a chili dog pattern. Um, doing anything other than trying to create something, right? There's just nothing to do, man. That's a great read. That's one of the hardest reads to make, is realizing that there isn't anything to do. And look at that. They're trying, aren't they? So AC Trader, all this is, oh, someone, it gets to be me every time. AC Trader, so we work off of three advantages. Every time we trade, we work off of three advantages, and that's really what it is for new users. We look for momentum, and we look for a clear path, and we do both of these things on our biggest chart. So if it's crude oil, if it's the S&P, you're looking at what we call the 13-2 chart. I just call it the large chart because I'm not a technical guy. So the large chart is going to define direction. It's going to let you know whether you're in an uptrend or a downtrend. The large chart is going to define momentum. It's going to let you know whether or not the odds are favorable for the market to continue in the direction of that trend. And then the large chart will also define areas where the people that move the market are making decisions, where the sellers want to sell, where the buyers want to buy, and where they both take profits. So when we look at what's happening in crude oil right now, that's odds favorable momentum. And notice how the market really does. It pushes up. There's a great push coming through. Um, and then it pushes right into Fibonacci support. So what Nick is identifying is rule number two, the advantage of not trading into areas likely to stop the market. This is 100% textbook by the rules. A giant red flag for next-gen traders says don't go short into support. And then when the market pushes right back up to resistance and the triggers don't break and the trend isn't there, it also tells you don't go into resistance and then don't go in to this divergence low. Yep. So the areas is both support and resistance. And what we do is we simply identify whether support or resistance is likely to hold or break. And so I don't get lost on it. All AC was pointing out, or I'm sorry, all Nick was pointing out was that rule number two hadn't been met for the last 30 minutes, meaning that the best option is to do absolutely nothing. It's not even that it's a pattern. It's just your rules not being met. Rule number two that gives you a clear path. And you're able to use Fibonacci to define that. And then when we talk about areas, anytime you hear the word area, we're talking about these right here. We're talking about red Fibonacci resistance. So anytime the market is trading up into one of those key areas, that key area has the potential to act as resistance. Anytime the market is trending down and it reaches a fib area, that fib area has the potential to act as support. So those are your fib lines, red for resistance, blue for support, trading up into resistance, trading down into support. Then these yellow one-to-ones are kind of like Fibonacci areas that are there in the moment. There's still an area that may stop the market. If the market is trading up into it, it'll act as resistance. If the market is trading down into it, it can behave as support. So everything really is support and resistance, depending on whether you're trading into it from below or whether you're trading into it from above. And then AC, we use that recipe that I teach every morning to determine whether or not these areas are likely to hold, whether they have the potential to break, or whether they have actually been broken. So the one thing that we've seen on crude oil for the last 30 minutes is that price reached one of those areas, and all of your trigger lines, the same trigger lines that give you that momentum, remained either below resistance or above support. And for us as Nexgen users, that tells us that the area may hold, it may create an untradeable bounce, it may create indecision. Um, so the clear path isn't present. And in crude oil for the last 30 minutes, there simply hasn't been a clear path. Do you see how that works? Price reaches, no trigger lines got below, so no short trades. It pulled back, trigger lines remain below, no long trades. So that's just rule number two, really designed to keep you safe. So what we're waiting for right now on crude oil is for both the small and the large triggers to get outside of this range, for both the small and the large triggers to say that either support has broken or resistance is broken so that we can embrace the idea of a clear path and look for an opportunity. Does that make sense? And then this class is very much a foundational approach teaching method. And it all sort of is based on, let me find my picture. It's all very much based on AC Trader. First and foremost, and this is for everybody, not just AC, being able to identify trends. So let me back up 1 second. I really feel that learning to day trade, and I know that my feelings mean nothing. My brother's going to text me that in just a second because feelings have no place in trading. But I really do feel that if you attack trading the same way you would eating an elephant, right? Has everybody heard that old analogy? How do you eat an elephant? You have to eat it one bite at a time because if you don't, the task becomes overwhelming. And if you try to be a professional day trader in the first week, you're just going to get frustrated, guys. So we start with defining trend. Is the market going up or down? And just committing. Let's trade in the direction of that market. And then once we can identify direction, and guys, this is really easy. Unless you're colorblind, then it's a little more difficult. And I have had clients that are colorblind. Small triggers break above the large, it paints it green. Small triggers break below the large, paints it red. Good morning, Miss Safia. So once you establish the trend, you're just going to look for momentum. You're going to look for that separation between small and large triggers. And this is rule number one. Strong triggers give you the advantage of momentum. This is the second bite. Once you have momentum, it's imperative that you have a clear path. And that's rule number two. Heck yeah, you can. I will give you everything on here. There you go. Once you have all of that momentum, you want to make sure that the path is clear, that there's nothing in between you and your targets. And AC, this is what we've been witnessing in crude oil for the last 40 minutes, is even with odds favorable momentum, we never had a clear path. We never had the opportunity to have nothing between us and our targets. So as a chart reader, this is where we shut it down. We say, hey, my rules aren't met, my path isn't clear. I'm gonna sit on my hands and I'm gonna do absolutely nothing. But if we do get that clear path and we do have that odds favorable momentum, again, starting our chart read from number one, that's when we'll start to look for entries. So the idea is that every time you enter the market, you have a statistical advantage. That statistical advantage is a byproduct of having momentum. It's a byproduct of having no termination conditions. Where the heck is my picture? And it's a byproduct of being able to take momentum in a clear path and then finding that point where the market is most likely to continue. And I can tell you, as someone that learned the software from zero, from ground zero, it is in fact a process. It's very much a process. And we embrace this high probability trend trade because it's going to turn you into a chart reader. And we embrace this idea of only two charts. Hey, Chris L., take care, man. Because it limits the number of things that you need to think about going into any trade. And then it's just repetition. It's you posting your trades in class, posting your chart reads in class, posting your questions in class, making sure that they get answered, learning the rules, embracing following the rules, simulating the rules, and then just keep it simple so that it becomes easy. Simulator is an amazing tool. It's like playing Monopoly. Nobody ever lost their home losing everything in Monopoly, right? But you might have learned some great strategies to get you to that next level. And that's what it is. Awesome. D-Rock, how did we change it? I'm not sure what I did, but I'm glad if as long as it's for the better. I don't want you deciding that kicking puppies is a good thing and then blame that one on me, right? It's all advantages, guys, and it's all chart reading. No, you definitely were trading well. And you know what the cool thing is, D-Rock, is there's a big difference. If I go short into support here, I'm not trading well, right? Because I broke my rules. If I go, hold on, let me see if I can find it. If I go short here with a clear path and momentum, and I lose, what's it mean? It just means that it didn't work. And I like that you put that because the reality is that's the trust part of what we do. When you see something 100 times, D-Rock, it gets easier and easier to accept the fact that losers happen. But here's the kick in the clackers, right? If I take 100 trades, I'm likely to lose 30 of them. But I don't get to pick which 30. I don't get to decide if it's 5 in a row or 7 in a row. I don't get to decide if I get 10 winners in a row. The only thing that I can do is embrace those rules that I back tested, that I studied, that I know win more than they lose. Rule number 2's kept me out of every situation here. So D-Rock, the second half of that is that's why I say to myself, if I take 4 perfect trades and they all lose, well, then something's not working and I shut it down for the day. I do have a stop loss. I have an amount that I'm willing to lose in a day when the patterns don't seem to be working, when I seem to be catching that whole 20, 30%. And then I also, when I have a goal, if the market is giving me that $1,000 pretty quick, I'm going to take it. I'm going to shut it down. My brother and I laugh about that all the time. We both send each other texts that said, hit my goal, shut it down. Hit my goal, shut it down. Because we're both, I can't speak for John, but I can speak for me. I've had days where I've been up $2,000, which is over my goal for sure. And I finish the day negative 200 because I get this Superman complex. I'm unstoppable. I'm bulletproof. I'm 10 feet tall. And I give it all back, guys. And that's one of the realities of trading too, is you have to define what am I willing to risk? What am I willing to lose? What do I want to gain? And then once you get those, it's so important to have a goal. Know what you're doing, D-Rock. And be willing to shut it down when you reach it. Or maybe you hit your goal and you say, I'll take one loser, or I'll keep trading if I win, right? If my goal is 500 and my last trade put me at 700, I'll say, you know what? I'll trade until I take a loser. And I might end that day back at 500, or I might end that day at 1500. Just depends on what the market wants to give me. Right? And then Snorri. Oh, it's good to have the old Snorri back. And while you're dealing with the trailing drawdown, you have a goal of 200 per contract. I have 250 per contract, Snorri. That's my goal every day. Because if I can consistently make $250 per contract, I can make more money than I can ever spend. I find personally that when I start holding for bigger moves, I start giving more back. I'd rather get paid, get out, and wait for the next one. And then, guys, this is a great picture from Snorri of that gap theory. For those of you that are studying it, price reaches the area, absolutely nothing breaks through, but those large triggers are below the reversal bar. This is another one of those, look, Nick, where price is likely to close the gap. And that's a great chart read. And then Safia, termination, momentum. You take the quick little snap back and get out at the trouble spot. Absolutely beautiful. Guys, I can tell you that Safia spent 9 months studying her chart reading to develop her plan, and now she is like King Kong eating cars. She knows exactly what she's looking for, why she's looking for it, and darn near every one of her trades look the same. And then here she just says higher divergence, termination, trading into a termination condition, right? Not even 50-50, Safia. You're going smack dab into a termination. 100%. Without question. But there's no divergence. Yeah. So sometimes we'll even make mistakes, right? Sometimes we'll go, oh crap, that might not have followed my plan. And it worked out, which is cool. Or maybe that was your plan. I love getting lucky. And then Gary's waiting for the breakouts. I love that. This is the patience picture. This is the, you know what? I'm not in control. I don't know what it's going to do. I'm going to sit on my hands. And Safia, that no divergence is what saved your bacon, I think. That no divergence with that immediate momentum. So you managed it well and you took advantage of it. And I think that that was a nice look. And then Paul, is this gold? This is gold. You're welcome. Everything says down, market pulls back. You're outside, right? Waiting for that reversal bar makes it easier, I think. No risk as it goes through. Paul, this is one of those instances where I think that reversal bar is very justified because you're so far outside of your large triggers. You've had divergence. You have weak triggers. You just don't know. Does this mid-band carry more weight than a multi-time frame Fibonacci area, right? Do you think the people in charge see your mid-band and go, ah, to hell with the fib, he's got a mid-band? Or are they more likely to push it back to the fib, right? And they did to the tick. That reversal bar reduces your risk dramatically and at least gives you a little bit of a way to establish your risk to get in with a little less. Because if this reversal bar never happens and they decided to push up to the mid-band, you never find yourself in this trade. I love fighting my brother more than anything in the world, but I'm telling you, on trades where it's not perfect, that reversal bar is one of the smartest darn things I've seen done. 1, 2, 3, 4 hits on support. 1, 2, 3, 4 hits on resistance. AC, did that little lesson help? First we look for trend, and then we look for momentum, and then we look for the clear path. And the clear path is what we've just never had here. What a wonderful safeguard, right? And look at this. Weak triggers, 50-50, divergence prints. It's okay. So eat that elephant. Has anyone in the room other than me ever gotten a little overweight and had to lose it? And you say to yourself, dag nabbit, I got to lose 50 pounds. And then when you look at that 50 pounds, you're like, gosh, that's a lot of weight to lose. That's a little overwhelming. How am I going to do that? But if you say, you know what, and this is what I did when I was a personal trainer. If you say, I'm just going to lose 1 pound a week. That's it. I'm going to lose 1 pound a week. I'm going to focus on small manageable goals. What you find is that you get the opportunity to celebrate every week, to have a victory every week, right? To keep it small, keep it concise. Paul, reversal bar. I like that you got back in. Everything's set up, right? You knew that it was likely to go up. You just didn't know where from. They wanted to push lower. It hits the fib. The triggers don't blink. The gap theory's in place, and you take the close on the correct side and go absolutely gangbusters on that one. Beautiful trade. Do you guys see it? Paul, that was a high probability that just didn't work. The fib doesn't guarantee a winner, does it, Daryl? Show me the picture. You love to show me winners. Show me a loser. Guys, I had to take a trade like this yesterday too. I took the perfect trade. When it didn't work, I took the second chance. Guys, I love your winners. I love celebrating victories with you. I can tell you right now from experience, you will get 1,000 times more out of a loser than you ever will a winner in regards to education, right? Look how the S&P stuck. They tried to go up and couldn't. They tried to go down and couldn't. They tried to go up. Let's let them break, guys. Let's wait for those advantages. And then crude oil is still all caught in a mosh. Beautiful trade, right? I love Daryl, this is the same one. Yeah. Odds favorable, clear path, perfect entry, didn't work. And then you took it again at the fib with the reversal bar? No? Do you see how you could have? If the large chart doesn't blink, if the large chart is still odds favorable clear path, I'll look for a second entry. I might wait for that reversal bar. Um, or you could choose not to get back in. That's totally cool too. Because by the time you hit that 23 fib, Daryl, this isn't odds favorable anymore. Does that make sense? Hey, Gene Bartley. That's a good test, man. I got you loud and clear. Welcome to the room. So, Daryl, by the time this comes down to 23, your smalls are against you. They're inside of large triggers, right? Rules 1 and 2 are no longer met on the large chart. I think that's perfect. That's brilliant. D-Rock, you go from high probability. So it depends. Let's say hypothetically. Let me take a picture of the picture. Guys, we're going to have to use our imagination a little bit on this one. D-Rock, the perfect trade is right here, right? We all know that. Odds favorable, clear path, nothing in the way. Oh, that's the one. So let's say, just for grins, D-Rock, I had a fib at 30. I have a fib at 30, right? It's a little outside of the window. Everything still says odds favorable. The path is still clear. And I get a reversal bar right here off of the fib when nothing has changed on the large chart. That's where I think using that reversal bar for a second attempt is good. Does that make sense? And then this one, when it does get to 23, when it does get to the mid band, it's pretty easy to see that the conditions have changed on the large chart. Yeah. So that reversal bar doesn't work out. What Paul did was a great read, and I want to show you why Paul did what he did. Paul took the perfect trade. And that is 23. And when he gets here, what Paul recognized through experience that maybe you guys won't recognize in the moment is that the gap theory was fully in effect there. That the large were a full bar away, that they were still up, that everything said support was likely to hold. So Paul took a shot. Does that make sense? It's a beautiful chart read, D-Rock. It's pretty far outside of high probability trend trade scenario. It's hoping for that gap to fill. And look at where his targets were. On the way up to the gap, secured everything, and left one on to hit that next area where it was likely to go. From a bad top, straight to support and mid-band, gap theory, conservative entry with the reversal bar, giddy up. Nice trade, Paul. That's chart reading, ladies and gentlemen. That is chart reading. I love chart reading. I get excited. Oh, Ron. Divergence, weak triggers, divergence, clear path, all that momentum, giddy up. Let's get out at the trouble spot. Small trade, more contracts all day long, brother. Not a high probability trend trade. I'll tell you what, though. 98% of Ron's trades look exactly like this. He throws 2% out there to upset my stomach. One day I'm going to meet him in person. We're going to talk about it. Looks good in the checkbook, doesn't it? Is there anyone in this room that couldn't live off $1,000 a day? Who's going to win? Buyers or sellers, guys? What do you think? Who's going to win? I don't know. You do, Safia. But, Safia, I love that you posted that one that didn't quite fit your rules. I knew it, didn't I? And guys, this is one of the things. This isn't, oh, I'm such a badass. But when you post in the room, I recognize your habits. I recognize your tendencies. I recognize the things that maybe you don't recognize in yourself. And I point them out and I go, hey, Safia, this is just a little bit outside of your plan. This is a little bit outside of what you've been showing me and telling me you're looking for. Did you do it on purpose? And that's it. Show me everything, good, bad, and the ugly. So Paul, 50-50, right? Smalls are through, large are not, no divergence, pulls back to the area inside of favorable large triggers, and it even lines up with a high volume area. Whew. That's a lot of advantages, isn't it? That's it right there, isn't it, Paul? It's still a 50-50. But that's a good look. That's a rules-based trade. Oh, man, the sellers are trying, aren't they? It got you. It's a good look, Paul. So, guys, let me tell you a little story about 50-50 trades after consolidation. I had to learn this one the hard way. I really did. So this is crude oil, right? This is the last freaking hour in crude oil. You guys that are bored, and I'm not telling you how to trade, I don't give trading advice. You guys that are bored, let's do arrows that are easier to see. When the market's been doing this, dang it, I don't want that arrow. I want white arrows. When the market, oh, it's not. Nick, Brutal is trying to take trades in there. This is you being a professional wader. All right, so here we go, right? This is what it's been doing. I'm going to tell you right now that there will be no less than 10 people in this room that the second these small triggers eke their little heads beyond that area, they're going to take the trade. Or the second the small triggers eke their head just above resistance, they're going to take the trade. You guys know who I'm talking to in here. You know who you are because you're so freaking sick of waiting that you're going to take the first 50-50 shot after consolidation. I'm not telling you it's the wrong trade, but what I am telling you is that when the market has been fighting like this, John Novak coined this phrase a long time ago, the fake out breakout. The buyers may let the sellers think they have it and then just demolish it the other way. Or the sellers may let the buyers think they have it and then just demolish it the other way. 50-50 trades after consolidation are low probability trades. 50-50 trades after consolidation, they either work 1,000% and you get paid huge, or they don't work 80% of the time and you get run over fast. Rule 2 is still keeping you guys safe. Guys, if you walked into this room today without faith in Fibonacci, I hope you're walking out with absolute faith in Fibonacci. Because it sure is keeping you guys safe today. It sure is keeping you from hoping, from wishing, from wanting. Beautiful trade, Gary. Guys, I expect nearly every one of you in this room to take that small loser. I'm not sure I would have put that much risk on it. Why? Why get mad? Guys, don't waste your emotions on anger. You're not in control of the market. You're walking into a cage with a bear, and you're hoping that bear doesn't decide to eat you. That's all it is, guys. That's what trading the market is. I would have put my stop 3 or 4 ticks beyond the lowest point I expect that market to go. So from 71.93, I don't think I would have been anywhere beyond 70 personally. Because at 70, I'm a point and a half, 2 points below every place I expect to hold, right? Does that make sense? Outside of the window of opportunity. I'm not running it super tight. I'm giving it 3 or 4 ticks to breathe. But Gary, can't we agree that if it doesn't go from this mid-band and support, it's just not that great. Guys, that's a great loser. Guys, ever see Last Samurai? It was a good death, right? Guys, that's a good death. That's a great look. That's just one that doesn't work. But look at, when it doesn't work, there's the NASDAQ. It doesn't work fast. And then there's another 50-50. And it doesn't work fast. Sometimes they give you what we call an apology trade, right? Jose, same one. Beautiful. And Jose may be a little tight, but shoot, that's great, isn't it? And then Jose, mid-band with the large triggers a full bar away. Damn it. That 21, right? You guys see the trickle-down theory here? Let me show you something. Because we still have 30 minutes, and I love this. So let me take this picture real quick. Jose, I'm going to use your pictures as an example because I think it's a great example. I'm just going to rearrange the order a little bit. So here's 2 charts, right? And on 2 charts, you have a 50-50. It's not really a good bottom. It's a higher divergence, but it's definitely not a termination that creates a full reversal. Does that make sense? That's the first thing. We didn't reach the one-to-ones. One-to-ones are exact. We never made it to the fibs. Not a good bottom. It's just a higher divergence. Smalls are up, large are up, momentum is great, no divergence, tiny window. Jose, this is a beautiful trade, right? And let me do a little annotation. Because this chart is not perfect, this chart must be. Does that make sense, everybody? Because this chart isn't perfect. It's an area with the potential to break but hasn't broken. This chart must be. This chart must have strong triggers, no divergence, tiny window of opportunity. Guys, this is the most beautiful 50-50 setup that you can take. So let me do this. Remind yourself, is 50-50, whoops, high probability trend trade? Is a 50-50 a high probability trade? Answer this question for yourself right now. If a high probability trend trade wins 70 to 80% of the time, isn't it logical that a medium probability trend trade might get you into that 50 range? Maybe. Which means that every time you take one, you're going to lose every other trade. Does that make sense? Guys, you don't get to stay in 70 to 80% winners if you incorporate medium probability trades into your scenario. I'm not saying that they're bad trades at all. And I've given you a plan that shows you the absolutely best way to take them, right? To give you the highest chance of success. And Jose followed this one to the letter. I would do that. There you go, Daryl. So then let me show you for you guys that incorporate more charts. Let me get this up here so that we can see all 3. Jose said that this was a termination condition on the 21-3, right? So guys, Jose, I think you're really going to like this. I'm going to take this. Oh, it's not going to let me do it. Because this chart isn't perfect. This chart must be. Jose, I think this is the keys to the kingdom for you on 50/50s because you run that 21 chart. If your 21 chart isn't perfect, insist that the 13-2 is. Just the same way that we insist if the 13-2 isn't perfect, that the 5-1 must be, right? For those of you that are taking 50/50s, taking that medium probability trade, give me a Y if that makes sense. And here's the picture for it, right? Odds favorable. Everything's going. This area has the potential to break. My money is worth the perfect entry on the 5-1. It's worth no divergence, strong triggers, and a tiny window of opportunity. Jose nailed it. All of you that took this trade, 100% nailed it. Feel good about taking that trade. It means that you have confidence in the methodology. The second I begin to deviate, it goes down in probability. The second I begin to sacrifice, it goes down in probability. Why? Because everything revolves around advantages. And if I'm giving up a clear path, why on God's green earth am I giving up momentum in an entry area, right? Does that make sense, everybody? And then the next level, guys, if you're going to take 50/50 trades, if you want to incorporate that, what Jose has just done is Jose has given you guys one of the greatest tools that you can use. Incorporate a 21-3. And when you have a 50/50 trade, insist that your 21-3 is rock star. Something to think about. I don't use a 21-3. I would take this trade every time and I would lose it, and I would manage it very similarly to how Jose did. I love his execution on this. D-Rock, perfect. 100%. 100%. Beautiful. Would you take it again? I'd take this trade every time and get my ass kicked and not shake my head a little bit. I wouldn't be angry. I wouldn't say the market's a butthead. I wouldn't do anything. I would just say, you know what? The area didn't clear. I took a shot. It looked good. But I think that the idea there, and if you incorporate this, if you are a larger time frame watcher, the same way if this chart isn't perfect, you insist on this chart being perfect. If this chart isn't perfect, this one better be, right? If you're looking at a 21-3 trading into a textbook termination condition, you're not looking for a 13-2 trade. And if you're looking at a 13-2 trading directly into a termination condition, you're not looking for a 5-1 trade. You embrace the idea. But for simplicity, for brand new users, we do it on two charts. Which means this one is chock full of kick-assery, guys. What a great lesson. Jose, thank you for that. Gosh, I love this class. Decisions being made at Fibonacci. Decisions being made at Fibonacci. You took your good shot. It didn't work. Let's wait and see. Now the smalls are below the large. The large are trying to turn, aren't they? They're trying to get below resistance, but they haven't yet. My triggers are split. Look at that trigger straddling the fib. 32 flavors of ugly, guys. You don't have to guess. Oh, they tried. Son of a gun. Guys, sometimes it's not the money that you make, it's the money that you don't throw away. Yeah, Jose, it's one of those things, man. If you have the tool, incorporate it. If you're not going to incorporate it, just get rid of it. Because when you look back and see what could have been, you'll be like, oh, dagnabbit. Guys, it's not the money that I made today, it's the money that I didn't give away breaking my rules, right? If I take 3 high probability trend trades and I win 2 of them and I lose 1, I'm probably up about $450. That's a great day. But if I take a trade into a termination and give away 200, Now I'm down to 250, right? And if I do it twice, now I'm at a $50 day. And I'm starting to question everything. So this is one of the reasons writing your rules on the chart is so important, right? This is one of the reasons that backtesting, that going through and holding Nexgen accountable, doing the work. Let me go back. This says ES perfect long. What does that mean? That means odds favorable, clear path, and a pullback to an area of support. Guys, click on every one of these links and start looking at what they all have in common and burn this image into your mind. Here is a perfect 50-50 long. What does that mean? That means everything is up and the area may break and there's no divergence and strong triggers. I'm telling you guys, all the answers are in front of you. Everything that you need is provided to you. The software, the platform to run it on, the education, everything is provided to you 100%. The only thing you have to do is enough study to learn how to trust the rules. Yeah, go spend some of the kids' inheritance. I love that. So let's go back to, and this is what Safia said, and I love it. Safia and I have an agreement that she's going to show me every trade, win, lose, or draw. And to minimize your learning curve, guys, that's what you have to do. You have to show me everything. If you're taking a trade, show it to me. Write the advantages on it. If you're reading a chart and you're not sure, and guys, you're going to do this. D-Rock, since you're typing, I'll ask you, have you ever looked at the chart and you've just thought, shit, I don't know. Is there a trade here? I'm confused in the moment. That's your big warning sign to do nothing, right? But if you're just not sure, take a picture, post it in the room. We'll talk about it. Hey, Mark, I'm wondering what the hell's going on here. What do you see? I'll tell you exactly what I see. And I'll always relay it back to the three advantages because I believe in them wholeheartedly. But post your trades in class, guys. Every win. That's it. You've got to make errors. You've got to make errors. Back when I was lifting weights a lot, guys, the body grows through failure. You get stronger through failure. You get bigger through failure. You get smarter through failure. I still make them, D-Rock. You guys know what I did today? I had my finger on the mouse and I was contemplating a long, and then I said, oh, that's not my trade. And my right hand decided that it should go ahead and left click anyway. And I entered a trade and I lost $200 instantly before I could recover. That's a mistake. Keep your finger off the trigger until you're ready to shoot, right? But guys, if you show me every trade, if you show every win, every lose, every draw, you're going to get feedback on all of it. You and I have a one-on-one session. We're going to talk about what looks great. We're going to talk about what doesn't. And if you win and the rules are wrong, you have a short-term victory but long-term failure, because now you're telling yourself that it's okay to break your rules, that it's okay to venture outside of that statistical advantage, and it's okay to hope for luck to be what pays your bills. And that's a horrible plan. How are you going to know the difference? You need feedback, guys. We're here to help. I'm here to help every day. John Novak jumps in here. He's got 27 years. He wrote the software. He sees things that I don't see. And he'll give feedback and he'll share patterns. If you stay on the simulator, guys, you can't lose money on the simulator. If you participate in class, you can't lose money through participation. All you need is feedback. You need to know what you did right or wrong, and that's what I'm here for. And I am definitely the warm, fuzzy Novak. I'm going to lift you up and we're going to celebrate victories. But when you start repeating mistakes, I'm going to say, hey, Bobby T, I see a pattern here. You keep hoping fibs are going to break and it keeps taking your money. How many more of those are you going to do until you believe it, right? Because that's what my brother did with me, guys, when I learned the software. I didn't post in the room for 3 months. I didn't ask questions for 3 months. I didn't use a spreadsheet for 3 months. But you know what I did do right at the third month? Is I went live and I took 21 losers in a row and I lost 5 grand instantly, and it was embarrassing. And I had to come back with my tail between my legs and I had to say, John, I hate you in the market. And then I had to work through that. And I said, okay, I'm ready. I'm going to post all my trades in class, and I'm going to use the spreadsheet, and I'm going to write a plan, and I'm going to stay consistent. And it's amazing how things turned around. So that's your path, guys. That's what we're doing. And Gary, absolutely. Poop emoji happens every day. Keep it simple. Keep it focused. Read this. It's 101 pages. It'll take you about 3 hours, most people. Read this. Both of these deal with the psychology of trading, of understanding and embracing advantages. Both of these talk about understanding that you're not in control of the market. And one of my favorite things in the emotion-free trading book is it tells you to stop beating yourself up when you make mistakes. Trading isn't easy or everybody would do it, guys. You're going to make mistakes. Give yourself a little bit of grace. You're brand new. And these are the 6 most common signs that you're maturing as a trader. I think that's great, D-Rock. I think that's an intelligent choice. Iron out the problems, right? Everybody gets lucky in their first 30 days because they stick to the checklist, they stick to the plan. Right at about 30 days, human nature dictates that we break away because we're so damn smart. That's where people have problems. Get through that problem area, right? Guys, when you manage your risk before reward, you know you're maturing as a trader. When you trade with stops and you put it where the market shouldn't go, you're maturing as a trader. When you're relaxed making trades, it means that you trust your rules, you trust the advantages, and it means that you're willing to take the trade because there's a statistical advantage, not necessarily because you think you're going to win, because you don't know if you're going to win or lose. You just stay relaxed and execute. And that means that you don't force or chase trades. You don't try to impose your will on a market that doesn't give a crap about your will. Trading shouldn't be your daily adrenaline fix, guys. Trading should be, it's a job. Go jump out of planes and swim with sharks if you want an adrenaline fix. Trade to get paid, right? Follow your plan. Most successful traders have 1 or 2 looks that they commit to. And then finally, this is my favorite one because I'm the huggy Novak. Your worth as a trader and your worth as a person are 2 separate things. Your worth as a trader has nothing to do with your worth as a person. Your abilities as a trader have nothing to do with your abilities as a person. Trying to get to that ES. Look at that, guys. Odds favorable. Clear path. What D-Rock is saying is that if I get a pullback to an area of resistance inside of favorable large triggers, my money is worth a shot, right? What do we notice about the triggers? They're a little split, but this midband's the only area. And then this goes back to, this was not a good bottom. This is not a termination that creates a full reversal, which makes this 50-50 less likely, which makes it more likely that the sellers are trying to push that move down to 43.58. And if there's an opportunity, some of you may jump on it. But rules 1 and 2 are met without question in the moment, guys. Oh, they almost made it, didn't they? Who put that damn fib there? Nick, going short. You went long. Oh, Nick, you went long. Why? Let me open this up and take a look at it. You went short into a termination condition, right? Didn't let it break. You had all the momentum. Whew. That's gutsy, brother. Nope, you're in at 71. You're in right here at 71. Your cyan line is up here at 85, isn't it? So, Nick, you did exactly what people do, right? The market consolidates forever, makes a move. That is textbook termination. Absolutely no trigger lines. Yeah, you had a little purple dotted line. That's nothing. Large chart defines direction, momentum, and areas. Small chart is an entry chart. Large chart has momentum, does not have a clear path at all. None of the trigger lines broke. Do you see it? None of the trigger lines broke. You got in at 71. You got in at the bottom of the move, my friend. Directly into a termination condition. Does that make sense? Not knocking you for it. Always start with the large chart. So Nick, The small chart will talk you into stuff. The small chart is that cute girl that gets you into a fight at the bar. Stands behind you and says, go, come on, I dare you. Look at it. It's perfect. What are you going to do, right? Large chart is your sober friend. And he goes, dude, Nick, seriously, the guy's 6'8", and none of the triggers have gotten through. Don't talk shit. He's going to end up bouncing you. Does that make sense? You could even do this, man. Lose that small chart until the large chart says go, especially as a new user, because it keeps you out of that short, Nick. It keeps you out of that one. And the fact that you made a couple ticks is only teaching you that it's okay to break your rules, but your rules are designed to keep you safe. I love that you posted it. And I hate that I had to tell you that was a rough look. But that was a rough look. That's exactly how you're going to learn. Dude, take every one that you see. Take every one that you see. And you and I will have a conversation about every one of them until you're so sick of me that you'll follow every rule that you create for yourself. How to Commit Financial Suicide, guys. One easy step by John Novak. There's only one page with information. All the other pages are left blank. Chapter 1, warning signs your friends are in trouble. They're trading against strong triggers. Fighting momentum. Fighting the trend. Chapter 2, warning signs your friends are not paying attention. They trade into termination conditions. Why? Because 60% of the time, termination conditions work every time, guys. You're going to get lucky every now and then. But this was a little tongue-in-cheek book. Not even really a book. It's just a picture that John made. He was playing on Photoshop one day. But it just reminds us that we don't have to give away the advantages. We don't have to hope, right? We don't have to wish. We don't have to want. We just simply have to wait for the absolute best of the best. There's those split triggers a little bit. That might be one of those times. If you got in at the mid-band, you made quick money, you went break even. And now this is where some of you might wait for the reversal bar. Some of you might say, I don't know where it's going to go to. I'll wait for the reversal bar. If I get it, then I'll go short because my risk is already established. But split triggers, guys, that can ruin a party. But the large chart has odds favorable. The large chart has a clear path. See how that works? You take the first perfect one. When the second one isn't perfect, you at least give yourself a fighting chance. And if you say something like, if divergence prints, I'll exit the trade, you can reduce risk a little more. This right here represents a potential trouble spot. I'll take my first profit there. And then D-Rock says, I'm probably going to rock it to the fib. So two different entries. The first one without divergence was the best. The second one, when it's not perfect, says at least give yourself a fighting chance. If divergence prints, then I will exit the trade. Does that make sense, everybody? And then Daryl, that's one of those ideas that when the large chart still says go, the large chart still has odds favorable, the large chart still has a clear path. If nothing else, waiting for that reversal bar at least gives you a fighting chance and established risk. It doesn't guarantee a winner because these triggers are split and it still may go all the way up. Divergence printed, that's what I said, right? I'll get out of this trade if divergence prints. And sure enough, it goes up to those large triggers. And now we'll see if it goes down. This is why split triggers can be a thorn in your side. You got your first target, D-Rock? Awesome. Did you get out break even on the second? Or did you hold it a little longer? And now that it's hit those second triggers, guys, it has a better shot at getting down to that area. You leave the stop above pivot. Awesome. See how it closed the gap to the large triggers? This is what we're going to end on today. Guys, this is why I teach favorable large triggers. Because favorable large triggers, when they're one on top of the other, it puts your bounce spot in the same area. It gives you the least amount of risk. When your triggers are split, you don't know. Is it going to be the low spot or the high spot? Are they going to the 1-to-1s or are they going from the mid band? Creates indecision. Sophia, directly into terminations again. That's 2 for 2. Congratulations, Dwight. You put 50-50, right? Okay, Sophia, we're going to do one little drill together. Large chart. Why didn't it work, Sophia? Fibonacci resistance, Fibonacci resistance, Fibonacci resistance. Your small triggers haven't broken through 3 areas, right? As I teach termination conditions every day, this is that financial suicide look. You take the first one off of support as it comes up to retest with the momentum. This second one, even this one is aggressive, but you take the conservative entry and the conservative exit. Getting back into your position was a pretty big challenge. But you put 50-50 and no term. Neither are true in this case, right? Does that make sense? You reached resistance all day long. The first one you had more of a fighting chance because it hit resistance and then it retested support. And I think this is the good conversation here. So let me take a picture of this. My thoughts. Great bottom, right? Beautiful. And from this great bottom, from this termination that creates a full reversal, price goes all the way up to textbook terminations, right? Like, boom, that's it. And then from that resistance, it comes all the way back to Fibonacci support. Well, when it comes all the way back to Fibonacci support, your large are still rolling, your small are still going up, right? So it pretty much tested 2 termination conditions. Just based on your trigger line look in this good bottom, doesn't it make sense that the most likely direction is up? I'm not saying that it's a high probability trade, but I'm saying that your larger up, your smaller up, your trend is up, your larger up, everything says up, and it retested. It came back and it hit support and started rocketing. And you waited for the close on the correct side, right? Which lets you get paid at that same termination condition. Does that make sense? This is definitely chart read. But at this point, you tested resistance and it held like a champ, right? And then when you get to it, your trigger lines still aren't through it. Your large triggers are a full bar away. Gap theory. So this long doesn't have nearly as many advantages right at the termination condition as this did to get back to the termination condition. Does that make sense? Awesome. I love the first trade. It's not my trade, but I love that one. And I think just getting that second one out of there, that's the hope trade, right? That's where you want to get stuff to break just a little bit. And I know that you were thinking break through and pull back to the 1-to-1s. I recognize that, but the part that you didn't give it was the clear path. Yeah, but even with the good bottom, gap theory, right? Large triggers are a full bar away. Did it close the gap to the triggers? That's crude. That was yours, and then that one just created more of a bounce, I guess. And now it's all screaming down. Awesome. And look at that indecision right there. That made it tough to trade, didn't it? D-Rock got paid on the first one, and then everything kind of changed. It closes the gap to the large triggers, and then it heads down. That's the market being a butthead. And guys, crude still can't break out. And that's noon. We made it through the day. You guys made it through a lot of consolidation, which is cool. Um, I'm going to come back tomorrow morning, and we're going to do the same thing, guys. Can you show me the picture, D-Rock? Let's talk about it. So that divergence line, I didn't take anything. Which one? On the S&P? This divergence line acting as a target? Or this divergence line? Yeah, absolutely. Isn't that an area that may stop the market? Does that make sense? Absolutely, that could be a great place to take profits. And you're just kind of asking yourself, as I reach that divergence low, what's happening on my small chart, right? It also lines up with one-to-ones. I probably wouldn't go short into it, right? But what a great place to get paid. Absolutely. I like it. Good read, man. Great read, everybody. Rule number 2. Hell, I don't know, Snorri. That's like how many licks to the center of a Tootsie Pop, right? The owl gets 3. The kid's got 30. It just depends whether or not there's people to take the other side of the trade. I've seen people trade, 50 lots, 100 lots, and I see entries stacked until they can get into it. So I don't think there is an exact answer. And then D-Rock, that's why that's not a bad spot to take profits. And you knew about it for the last hour. And then Miss Debbie, I like your entry. You took the first one, you kept your stop safe, and you took it right down, and they missed you, didn't they? Great place to take profits because that was very much their line in the sand. Good stuff, guys. Great class today. A lot of great questions. Nick, great forward motion, man. AC, great job. Surfer Trader, you look so comfortable in your picture. Feel free to get loud if you need anything. And all you other folks that are brand new, welcome, welcome, welcome. Thank you for being here, guys. We're going to do it again tomorrow. We're going to go through the same process tomorrow. We're going to talk about advantages. We're going to look at your charts. We're going to sit on our hands and wait for the best of the best because this is a business, not a hobby. I'll see you guys in the morning. Take care, everybody.